So welcome people. So today we'll be starting with Ind AS 116 ka lease ka revision with the help of our chart book. Sir, as per Ind AS 116, what Ind AS 116 says is whenever an asset has been leased out. So obviously lease will involve two parties, lessor and lessee. Okay. So what Ind AS 116 says is if an asset has been taken on lease by the lessee has to compulsorily show two things. One is ROU account, another one is lease liability account. Right of use account and lease liability account. This is one of the basic requirement of Ind AS 116 for lessee. He has to show these two components. Okay, why the requirement or why the standard viewpoint is that is here in this example, let's say A Limited has leased a plant and machinery to B Limited for 3 years. So what standard feels is this B Limited has a right to control this asset or a right to use this asset for more than 1 year. So you have a right to control the asset for more than 1 year means so one asset has to be compulsorily recorded by the lessee and that asset ka name is ROU account. Okay, and B Limited got the right to use this asset just not at free of cost. He also has an obligation to pay periodic lease rental. That's the reason he also has to book lease liability account. Okay, and lease liability is recorded at present value of future cash flows. That means you have to use discount factor and whole lot of accounting is required. Okay, so that means Ind AS 116 ka lease accounting treatment is little complex, right? For small leases and all, if you start applying this complex treatment, it will be a little difficult. Hence, what Ind AS 116 says is there is some recognition exemption. The basic requirement of Ind AS 116 is lessee has to record ROU and lease liability. But that particular complex accounting need not be followed if recognition exemption is followed. So when do you get recognition exemption? Recognition exemption, you get for short-term lease. Short-term lease means those lease with the lease term of less than 12 months. If the lease term is less than 12 months, we call such as a short-term lease and lessee should not have an option to purchase the asset. Any lease where lease term is less than or equal to 12 months, less than 12 months and lessee doesn't have an option to purchase the asset. That we refer to as short-term lease. So for short-term lease, you get some recognition exemption. What is that? We'll see in a bit. Okay. And another one is the lease term should be defined at lease inception. You should find out the lease term at the beginning itself. Let's say lease term was 5 years. Okay. At the end of third year, you modified lease term and said we will continue the lease only for 8 months. Initially, when you enter into a contract, lease term was for 5 years. 3 years went on smoothly. In the fourth year, you modified the contract and said the lease will continue only for 8 months. So now can we treat it as a short-term lease? No. Lease term should be defined, or if you want to account it as a short-term lease, you need to check the lease term from the beginning. Okay, the total lease term should not exceed 12 months. So in my example, total lease term is 5 years or 3+ years. So you can't take short-term lease wala exemption or recognition exemption is not permissible. Okay, that's one. And if you have any low value assets means those assets which are high in number but low in value. Low value assets ka example could be your laptops, your iPads, your phones, office furniture, etc. etc. Okay. For these assets also you can take recognition exemption provided sublease should not be done on them. Sublease means letting it out again. Lessee will take the asset on lease and again sublease it, which we'll talk about it a little later. So sublease should not be done on low value assets to take the recognition exemption. Okay. There's also another one. Low value assets means those assets which lessee can use on its own. Lessee can benefit from using it on its own, and assets are not highly interrelated or interdependent. If you have taken multiple assets on, let's say you have taken 10 laptops on lease, all the 10 should not be interconnected. It should be possible for you to use all the laptops individually also. That's what we mean by that. So basically for two kinds of lease, you get recognition exemption. One is your short-term lease, another one is your low value assets. So what is this recognition exemption that we are talking about? Recognition exemption is simple, sir. In your golden days, in your bachpan, in your 11th and 12th grade and all, what is the journal entry for lease rental paid you used to account? For the guy paying it, you used to account it as an expense. For the guy receiving it, you used to account it as income. Meaning lessee used to show it as lease rental account debit to bank account and lease rental expense, they used to transfer it to P&L account. That is the recognition exemption. Meaning you don't have to follow this ROU lease liability accounting and all. Simply you can treat lease rental as an expense for lessee and for lessor it will become an income. Are we okay? So this is the thing. But this lease rental income has to be booked on a straight line basis. That we'll talk about it a little later. Okay. Meaning every year the lease rental that you book has to be same. Okay. If you have paid more means show it as prepaid expense. If you have paid less means show it as outstanding expense. But every year the lease rental that you transfer it to P&L has to be on a straight line or any other systematic basis. But generally we use practically straight line basis itself. That is one. Okay, sir. This is about recognition exemption. Alright, next is lease ka definition. Lease means what, sir? It's basically a contract or a part of contract which conveys 4 things. The right to control, the use of an identifiable asset for a certain duration called lease term in return for a payment called lease payment. If you want to call it as a lease, that particular contract should have 4 features. One is right to control, RTC, the use of an identified asset for a certain duration called lease term in return for a payment called lease payment. Okay, if you look at the definition, they say contract or part of the contract. Sir, what does part of the contract mean? Sir, let's say you have taken a car on lease. You have not purchased. You have taken a car on lease. Okay, and not only car, you have also taken car driver service also. Okay, from one vendor, no, you took car on lease as well as you have taken driver assistance. All right. So this driver is a service. It is not a lease component. This car is a lease component. We call it as LC. Driver is a non-lease component. Fair enough. So that means in this contract, there is a lease component also. There is non-lease component also. That means entire contract is not relating to lease. Only car ka portion is relating to lease. Because if you want to call it as a lease, there has to be an asset. But this driver is a service. Okay. So that's the reason this part of the service, this part of the contract is not a lease. That's the reason we use the term contract or part of the contract. Even if part of the contract has a lease element, still you can apply Ind AS 116. That's what the definition says. Okay, sir. Now we'll go through the things one by one. Okay, but all this will come in the future stages. For now, it's okay. Let's move on to the next thing. Okay. Next, we have something called substantive substitution rights or supplier's substantive substitution rights. So what is this? Sir, it's simple. If supplier has SSR, then the customer does not have RTC of identifiable asset. So for you to call it as an lease, RTC of identified asset should be there. Meaning identified asset should be there. But if supplier has SSR, means customer, meaning the lessee, will not have identified assets. That means the whole contract will not be a lease at all. So we didn't understand, sir. What this means is, let's take a small example. Lessee has taken an SUV car on lease. Okay, one SUV car on lease, lessee has taken it. Okay. So what is lessor doing is, and the car belongs to the lessor only, okay, and the car, no, all right, what the lessor does is, okay, the lessee wants to use this car, let's say lessor wants to use this car for 2 years, okay, the arrangement is morning the car will come to lessee ka premises and lessee will use that car for whatever work it is, and then the car will go back to lessor ka premises like this. This is what happens daily. Morning it will come, lessee will use it, and evening again it goes back to lessor ka premises, okay. But what lessor is doing is daily he is sending different cars, sir. First day he is sending black Innova car, next day he is sending red Innova car, next day he is sending Mahindra XUV, like this different SUV cars he is sending. Okay, that means what is the lessor doing here? He is substituting the asset. One asset he is not giving over a period of 2 years. Every day or every month or every week he is substituting the asset. That's what we mean by substantive substitution rights. So if lessor is using the substitution rights, that means you tell me, sir, can lessee identify which asset he's clearly using? No, daily he's using different cars. That means which asset did he take on lease? For you to call it as a lease, asset should be clearly identifiable. Which asset you have taken on lease, you should be able to clearly tell. But in this case, you can't tell that because asset is going on getting substituted. So that means in this case, what? Supplier as in lessor has what, sir? SSR, as in substantive substitution rights. Since lessor has SSR, customer will not have identified assets. That means this whole contract will not be a lease at all, meaning you will not apply Ind AS 116 for this provision. That's what this particular component is. Okay. So when do we prove supplier has SSR? Sir, if supplier has SSR means you check for 2 conditions. One, the supplier or the lessor should have the practical ability to substitute the asset. You should have the ability to substitute the asset. In my example, it is possible to substitute because lessor and lessee are staying probably in the same region. Maybe both of them are there in Bengaluru. That's the reason the substitution is possible. Imagine lessor is there in Bengaluru, lessee is there in Chennai. Now, can we substitute the asset on a daily basis? Not possible. So that's what first condition says. Okay. So lessor should have the practical ability to substitute. And 2, it should be economically viable, meaning beneficial for lessor to substitute. Okay, if the lessor has the ability to substitute and if it is beneficial for him to substitute, then we say supplier has SSR. Okay, but substituting after a period of time, let's say in the contract, lessor tells if the car breaks down after 6 months, if car breaks down, I will send you a new car. That means this is what? Substituting after a particular event or after a particular term. If substitution is done after a particular point of time or after occurrence of a particular event, then it is not considered as supplier has SSR. Okay, these are all natural contract. Yes, no. If an asset breaks down means obviously you need to send a new car. Okay. In that case, just because you have sent a new car or replaced a new car does not mean supplier has SSR. In order to say supplier has SSR, he should have the practical ability to substitute throughout. One more word is there over here. Throughout the lease term. Supplier should have the practical ability to substitute throughout the lease term. Okay. All right. So that is the thing. So if he's substituting after a particular point of time or after 6 months, 8 months, or if a car breaks down, etc., then supplier does not have SSR. Okay, like that. And if the question is not clear, if they don't mention anything about SSR, we always assume that supplier does not have SSR, as in substantive substitution, right? That means customer will have identified assets, meaning you will account this as per Ind AS 116 only. As a thumb rule, we assume that supplier does not have SSR. That way. Okay. That is about your SSR wala drum. Okay. So let's go for the next one. Next is first identified assets. Yes, we saw the lease definition, contract or part of the contract which conveys right to control the use of an identified assets. Now we are spending a little more time on identified assets. Identified assets means the asset should be physically distinct. Which asset you have taken on lease, you should be clearly able to tell. Okay, that's what it means. So it can be whole asset or even part of an asset. Even part of an asset can be leased out. So what does that mean? Let's say there is a building. Building has 2 floors, ground floor and first floor. Lessee has taken only first floor on lease. Lessee has taken only first floor on lease. Sir, whole building is one asset. Is entire asset leased out? No. Only first floor is leased out. Okay. That means entire asset is not it's not leased out. Only one part. Even if one part of the asset is leased out, that is good enough. We still say this part you are able to identify. No. So that means lessee we are able to identify the asset. That's what we mean by that. Identified asset does not mean it should be whole asset. Even part of an asset is considered for this accounting purpose. That is one. All right. And if there is one asset which is used by multiple parties, which generally happens in your gas pipeline contracts and your internet contract, normally, let's say there are 3 natural gas wala companies. Okay. Obviously, you know that this gas and all, petrol, diesel, etc., will be transported using the pipelines across the country. Okay, across the world, across the country, across region, etc., right? Now, if every company says, I'll dig my own pipeline, that means every day, everybody is going on digging the pipeline and the roads and all will be damaged. Yes or no? Hence, government will not give permission for everybody. There'll be 1 or 2 major pipelines, and that pipeline will be used by many companies. Okay, so in that case, there is one asset used by many parties. Okay, let's say one gas pipeline is taken on lease. In that case, what to do, sir? So let's example, here there is a gas pipeline. It is used by 3 parties, or it is taken on lease by 3 companies, A, B, C. A is using whatever the gas is flowing through that pipeline. No, 95% of the product is used by A, B is using 3%, C is using 2%. That means one asset, if it is used by multiple parties, for whom it is leaser, so you need to check which party is getting substantial benefits. Which party is using for the asset for its substantial capacity and getting substantial benefit. In my example, A is using the asset for its substantial capacity or all of its capacity and getting substantially all of its benefit. That means for A, in my example, you will apply Ind AS 116. For B and C, it is not a lease. It's a normal supply, expense and income wala contract. It's a normal contract. It's definitely not a lease contract. That's what this is. So if one asset is used by multiple parties, whichever party is using the asset for its substantial capacity and getting maximum benefit. For that party, it will be a lease. For other party, it will not be a lease. So this is about identified assets. Next one is the first aspect of Ind AS 116 definition, which is RTC, right to control. So lessee should have the right to control what? He should have a right to control the asset. Okay. Now, what do we mean by right to control is what we are saying. This is pretty common sense. Right to control means what? Lessee should be in a position to direct its use. After an asset has been taken on lease, no? We say that lessee has the right to control the asset when he can use the asset the way he wants. Let's say he has taken an asset machinery on lease. Lessee can decide how many hours to use the machinery for, whether 4 hours, 5 hours, whether to use today, not to use today, where to store it, etc. Who should operate it? All this decision, the way the asset should be used or the direction of the asset or direction of asset usage, lessee should be able to control it. That's what we mean by RTC. All right. Obviously, why are we using the asset? We say right to control is there when the asset can be used by the lessee the way he wants, and from that asset he will get substantially all the benefit. Okay, so we say lessee has basically right to control when he's using the asset the way he wants, and from that asset he is getting substantially all the benefits, either by using it or by subleasing. Also doesn't matter. Okay, we'll talk about sublease little later. Okay, all right. However, if supplier has some protective rights, then we still say customer has or lessee has RTC only. So what does that mean? So let's say the car, let's say take the car example. Sir, lessor has leased a car to lessee, but this car is Karnataka registered. Have you observed every car will have a nameplate, no? So let's say this car is Karnataka registered. Lessor told the lessee, boss, don't take this car outside Karnataka state because I have taken the license, I've taken the permit from RTO, the transport authority. I have taken the permit only to be for the car to be used in Karnataka. This particular car can only be used in Karnataka because that's the permission he has taken from the lessor has taken from RTO. Okay. All right. Now can we say lessor is restricting lessee car usage? No. These are just protective rights. Okay. So obviously, if lessee takes this car outside the state, the car may get confiscated, etc., etc. Because yellow boards and all, if you observe yellow board cards, if it has all India permit, you can take all over India. All right. If it has only within the state permit, you have to use it only within the state. You can't take it outside the state. All right. So if lessee takes this car outside the state, means the on the car heavy penalty may be imposed or car may get confiscated also. So obviously that means car still belongs to lessor only, no? So lessor will have some protective rights. Just because lessor has put some protective rights for a restriction does not mean lessee does not have RTC. In this case, lessee still has RTC over identified assets. Okay, that is what we mean by given in the next point. All right, next thing is, what if the lease contract has many lease components? Many lease component as in, sir, there is one contract made by lessee and lessor and lessee. The contract says that two assets is taken on lease. One is building, another one is plant and machinery. Two asset is leased out, but you made only one contract. Okay, building is taken on lease as well as some machinery is taken on lease. So in this case, what to do, sir? Sir, building is a separate lease component, plant and machinery is a separate lease component. And are they highly interrelated or interdependent? If you use building, you have to use machinery also. Or to use plant and machinery, you need building also? Not necessary. You can use them on their own, right? These are not highly interdependent assets. They can be used independently. Yes or no? That means what, sir? This is a separate lease contract. This is a separate lease contract. So don't merge them. Even though you made one contract, you need to account them separately. That's what we mean by this. So if a contract has many lease components, you need to account them separately. You need to separate them and do the accounting separately. Okay. Sir, what if the contract has two like this? One lease component and one non-lease component. Like in my previous example, car and car driver. Sir, car is an asset. So asset constitutes your lease component. But car driver service is a service. So service and all, we don't treat it as a lease component. That means in this contract we have a lease component as well as non-lease component. So if you have a lease and a non-lease component, Ind AS 116 gives you a practical relief. You need not separate. Ideally, car is a separate thing, car driver service is a separate thing. Ideally, you need to separate. But Ind AS 116 has given one practical leeway or practical relief or one shortcut. What Ind AS 116 says is, if a contract has lease and non-lease component, you need not separate it. You can treat it as one account. You can treat them as one contract and do the same accounting. Whatever accounting Ind AS 116, you can simply follow that. Even for this car driver service and all, you can do the same accounting. You need not split up. This is the practical relief given in Ind AS 116. And this is optional. If lessee wants, he can still separate it, or he can use this practical relief and choose not to separate. That is totally lessee ka choice. All right. Next is lease term. So lease term means three components. One is the non-cancelable term plus renewal period plus termination period, or I'll call it like this, plus termination period plus renewal period. Let's take a small example. Sir, the lease contract says like this: 5 years is non-cancelable term. There is a lease contract made by lessor and lessee. The contract says for first 5 years, nobody can cancel the lease. But the total lease term is 8 years. The term mentioned in the contract is 8 years. And the contract says for the first 5 years, nobody can cancel. Nobody can cancel means it is a non-cancelable term. Then the contract says at the end of 5th year, meaning after 5 years, if lessee wants, he can cancel. After 5 years, if lessee wants, he can cancel. That's what we mean by, so that means what is this? After 5 years, he can cancel means this last 3 years, we call it as termination period. Who has this termination option in this particular example? Lessee. So what should be the lease term, sir? Based on the lease term, whole accounting will change, sir. Okay, because I already told you initially, in case of lease, ROU and lease liability is accounted, right? Fine. How do you get the lease liability? Present value of future cash payment. So if the lease term is 8 years, means you will consider cash flow for 8 years. If the lease term is 5 years, means you will consider the cash flow for 5 years, like that. So the whole whole number will change based on lease term. So lease term is quite important. Even ROU, the ROU is nothing but an asset. If the lease term is 8 years, means you will depreciate it ROU over 8 years. If it is 5, you will depreciate over 5 years, like that. That's the reason lease term identification is quite important. Okay. One is non-cancelable term, which is 5 years. That's okay. In this case, after 5 years, lessee can cancel it. So what Ind AS 116 says is, lease term is nothing but Non-cancelable term. Non-cancelable term you any which way consider. You will add a termination period. You can add a termination period. In my example, termination period is 3 years. You can add a termination period provided lessee intends not to exercise this option. You can add a termination period provided lessee is reasonably certain that he will not go for this option. If lessee is sure that he will not cancel, then you will add 3. If lessee feels, no, after 5 years, I will cancel, then the lease term will only be 5 years, meaning you should not add this. Only if lessee feels he will not cancel, then only you will add the termination period. That is one. So what about the renewal period? Let's say the contract term is 8 years. Another example I'm taking. The contract also can be renewed for 3 years. Initial contract term is 8 years. Another example. Okay, the contract could be renewed later on for 3 years. That means now what is the lease term? As per the contract term, it is 8 years. So should we take 8 plus 3, 11, or should we take the lease term to be only 8 years? That again depends, sir. Renewal period also, renewal period of 3 years also you can add, provided lessee is reasonably certain that he will renew. If lessee feels he will renew this contract, then you will take the lease term to be 11 years. If lessee feels he'll not renew the contract, then initially you'll consider it for only 8 years. So what if this changes later on? If it changes later on, we'll have to do some other accounting, which we will talk about it. You already learned this as modification. Yes, we learned about all that in a bit. Okay, so that's about your lease term wala drama. So lease term ka 3 constituents are non-cancelable term plus renewal plus termination period plus renewal period. Termination period you will add only if lessee is reasonably certain that he will not go for cancellation option. Renewal period you will add provided lessee is reasonably certain that he will go for renewal option. Okay, so that's about lease term. Okay. Okay, excuse me. I think about lease components, let's take up one question maybe. I think we have, we'll just check 1 minute. Oh no, we don't have that. It's okay. I think that's fine. Or we'll go through this and then we'll see. Okay, now about lease payment. I think till here we have covered. Nah? Okay, let's go for lease payment. Lease payment means it's a payment. Obviously, through this lease arrangement, lessee is able to control one asset. Yes, he's getting a right to control one asset. Obviously, if you want to get the control means he has to make some periodic payment. That payment only we calling it as lease payment. Okay. So what is there in that? No, it also has some drama. Lease payment has some components. What are the lease payment components? One is fixed payment. Usually the lease rentals are fixed. So if there is any fixed payment given in the contract, that can be part of lease payment. And in substance fixed payment, if there is any in substance fixed payment, that also can be added. So what is this in substance fixed payment? Let's say lessor tells the lessee, if lessee uses the machinery in a month, in 1 month, if lessee uses the asset, then he has to pay 50,000. Okay. If lessee uses the machinery, let's say for about 100 hours, like this. If lessee uses the machinery for 100 hours, then he has to pay a lease rental of 50,000 a month. And the contract says if lessee does not use means he has to pay a lease rental of 30,000. If he uses the asset, 50,000. If he doesn't use the asset, 30,000. That's what it means. That means you think practically, whether you use the asset, whether lessee uses the asset or he does not use the asset, minimum 30,000 he has to pay. If he uses the asset, then he has to pay. Cut off this maybe 100 hours. If he uses the asset, he has to pay 50. If he does not use the asset, 30,000. So that means 30,000 any which way you have to pay. That means it is what? Fixed only, right? That to what we call it as this 30,000 only we call it as in substance fixed payment. So if you have any in substance fixed payment, that can also be added. So what about that 20,000, sir? Okay, because this 30,000 you are considering, sir. What about 20,000? That cannot be considered. In a bit, I'll tell you why. Okay. So lease payment will constitute fixed payment plus in substance fixed payment minus any lease incentive. Okay, we'll talk about lease incentive also in a bit. Okay. Then variable index based on or variable payments based on index or rate. Sometimes what happens is, let's say your lease contract is 5 years. All the 5 years the lease rental has to be same. Huh? No. Obviously, every year based on inflation of a country, product price will raise. Yes. So the lessor may tell the lessee, based on inflation, I will increase my lease rental. Yeah. Or it could be based on consumer price index, or it could be based on LIBOR or MIBOR. LIBOR as in London Interbank Offer Rate, which normally is used as a benchmark for your bank loan transaction, or MIBOR, Mumbai Interbank Offer Rate. So based on this index or rate, if lease rental is varying, so that also can be considered. Okay. Because if the index changes, lease rental also changes. So if it is varying based on index, that also can be considered. Purchase price option. Sometimes in lease contract, the lessor will give an option to the lessee saying, if you want to purchase the asset, right now the asset is leased out, but option will be given to the lessee saying, if lessee wants, he can purchase of this asset. If such an option is there, and if lessee feels that he will buy it off, let's say he'll buy off this asset by paying 20 lakh, then 20 lakh also can be added to your lease payment wala calculation. This you will add provided lessee is reasonably certain that he will purchase the asset. Then only you will add, otherwise you will not know. So that means all these are estimate based accounting, and estimates can change later on also. Okay. Next one is exit penalty. Okay. So suppose the contract has an exit penalty, meaning say the contract has a clause where if lessee wants, he can cancel the contract. Let's say lease term is 8 years. Okay. After 5 years, if lessee wants, he can cancel the contract by paying a penalty of 1 lakh. And lessee feels he will exercise this penal option, meaning he will exercise this or he will cancel the contract after 5 years. That means lessee feels he'll pay this penalty. So the penalty amount also can be considered as the part of the lease payment. You'll add penalty amount only if lessee is reasonably sure that he is going for this termination option. If lessee feels he will not terminate, then no need to add the existing penalty or exit penalty. Again, this is an estimate based accounting. Also, if there is any guaranteed residual value, that also you will add. Guaranteed residual value means it's a guarantee given by the lessee to the lessor saying asset ka value will not reduce. It's simple, sir. Let's say the lease term is 3 years. Okay. Now, residual value means the value of the asset that the value the asset fetches at the end of asset ka useful life. Let's say useful life of the asset is also 3 years for simplicity. So residual value, let's say, is expected as 10,000 at the end of year 3. At the end of year 3. But lessee is being very reckless. He has used the asset left, right, center. Anyway, it's not his asset, no. So he's used this asset like crazy. Okay, he's used it to such a he's so negligent that you can't even see that asset. To that extent, the asset has got disturbed. Yes, that means now do you think lessor will get 10,000? No, it may fetch a lot lesser. So based on lessee ka usage, how much residual value lessor is getting is obviously, residual value is based on the lessee ka usage. Hence, what the lessor will tell in these contracts is, lessor will expect lessee saying, you give me a guarantee saying residual value will not come below a certain amount. Let's say here, lessee has given a guarantee to the lessor that no matter what, your residual value will be 7,000. If you get less than 7,000, lessee is saying, I will compensate. That means this 7,000 constitutes your guaranteed residual value. Guaranteed residual value is simply a guarantee given by lessee to the lessor saying, no matter what, 7,000 residual value you will get. If you don't get, then lessee will compensate to the lessor. That's what we mean by GRV. Okay. So in 10,000 is the residual value, 7,000 is GRV, means the balance 3,000 we call it as UGRV. Okay. So this GRV is also part of the lease payment because it is given by lessee to the lessor. No. So that's the reason this also will be added. Okay. That's what I've written here. But however, UGRV means unguaranteed residual value. Nobody has given any guarantee. So whenever you're doing calculation from lessee perspective, UGRV don't consider, only consider GRV. But whenever you're doing calculation from lessor calculation is not there much. Mostly this chapter is entirely around lessee ka calculation. But just saying, if at all you're doing any lessor ka calculation, always include GRV and UGRV. For lessee only you will include GRV because that's the only amount of guarantee is given. So for lessee you will not consider UGRV. For lessor you will consider both GRV as well as UGRV. Okay, the next one is lease incentive. Lease incentive is basically a payment made by lessor to the lessee. So lessee has to make the payment. No. Here lessor is making some payment to the lessee. How, sir? Sir, let's say lessor has a building which he wants to lease out. Okay, lessor has a building which he wants to lease out. Okay, lessor approached lessee and said, I have a building. Do you want it on lease? Lessee told, yes, I don't mind. I'll take it on lease. But currently I am already using one premises. If I have to shift to your building, I have to incur a lot of moving charges. Lessee saying, currently I'm already operating in one building. I have so many tables, chairs, laptop, and so many other things. Now, if I have to take this building on lease, I have to incur a lot of moving charges. Okay, let's say the moving charges is 1 lakh rupees. Lessor told the lessee, no problem, I will pay. Whatever is the moving charges you are incurring, I will pay. So that is called as lease incentive. So to get into this lease, lessor is giving some amount to the lessee. Okay, so that's what we mean by lease incentive. So lease incentive, since now lease incentive, think from lessee perspective. Lessee is paying this or receiving this? He is receiving it. So you'll reduce it from the lease payment. Okay, it includes your moving charges, transportation charges, etc., etc. Okay, so we already discussed this. If variable payment is part of index or rate, you can add it. However, variable payment is not based on index or rate. In the previous example, if you just check over here, okay, how is the lease rental charge? Whether you use or not, lessee has to pay 30,000. But if he uses the asset, he has to pay 50,000. That means based on usage, you are paying 20,000 extra. Correct? No. Sir, lease rental, it should not be based on usage or sales. It should be based on time activity. Correct? No. If you have leased the asset for 3 years, means 3 years you are expected to pay lease rental because you got control over 3 years. So the lease payment essentially is a time-based payment. Okay, it should be fixed. But if you are charging lease rental based on production, let's say lessor told the lessee, or based on how much ever units you produce, or based on that, I will charge you lease rental. on how many ever units is sold by lessee. Based on that, lease rental lessor is collecting. So if the lease rental is based on this, then it is not part of your lease payment. That is simply considered as an expense and simply considered as an income. So lessee will book it as an expense, lessor will book it as an income, but it will not form part of your lease wala calculation. So whatever Ind AS 116 treatment we are giving, it will not form part of that. This we used to call it as contingent rate. I don't know whether you remember this. In AS 19 terminology, we used to call it as contingent rate. This is not there in your syllabus. I just gave it for your reference in case you remember this. Okay, don't write this and all in exam. Okay, because we are in CA final now. AS 19 uses this terminology. Okay. Next one is IDC. IDC is your initial direct cost. That's your DAC. In your PP, we studied about DAC, directly attributable cost. Similarly, for lease contract, sometimes lessee could be in one region, lessor and lessee could be unknown parties. Some broker could help the lessor and lessee to meet and form a lease agreement. So obviously, broker may you have to pay some brokerage, etc., etc. So all that brokerage and all we call it as indirect IDC, indirect initial direct cost. So what to do for this? I'll cover it a little later. I've prepared another chart for it. Okay. Okay, sir, what about discount rate? So I already told you lease payment initially you will recognize it at what? Present value of future cash flows. To find out present value, we need discount rate. So the first priority for discount rate in your problem is always IRR, implicit rate of return, or we used to call it as EIR in our financial instrument topic. So first priority is always IRR. If IRR is missing, IRR is always from lessor ka perspective. Okay, IRR, because the lessor is basically the financer. He's giving away the asset but collecting the amount in installment. So lessor is basically a financier. So rate, so if you want to take a bank loan, you will determine the rate or banker will determine the rate. The banker, that is financer, will determine the rate. That's the reason the rate is always from, or IRR is always from lessor ka perspective. Okay. But however, if IRR is missing, then you can use lessee ka incremental borrowing rate. Okay. That's for your calculations. Now the next thing is lease accounting. So how does lease accounting works? Okay. So you already know this. Only for few leases you can take recognition exemption. For all other leases, lessee has to compulsorily show ROU and lease liability. How to do it? Let's learn it with the help of one question. Excuse me. Okay, let's take up question number 31 maybe. Company EFG enters into a property lease with entity H. Okay. The initial term of the lease is 10 years with a 5-year renewal option. All right. The life of the asset is 40 years and the fair value of the lease property is 50 lakhs. Company EFG has an option to purchase the property at the end of the lease term for 30 years. So lessee has an option to purchase the asset at the end of the lease term for 30 lakhs. So there's a purchase price. Okay. Can you add this to lease payment? Yes. Provided lessee is reasonably certain that he will exercise or he will go for this purchase option. First annual lease payment is 5 lakh. Thereafter, it increases by 3% every year. IRR, they have given implicit rate of return or internal rate of return is 9.04%. Entity H gives EFG an incentive of 2 lakh rupees. Entity H here is the lessor. EFG is the lessee. Okay. Entity H, that is the lessor, gives company EFG an incentive of 2 lakh rupees. That means this is your lease incentive, LI. That should be reduced from your lease payment. We already studied. Yes. At the beginning of year 2. So whenever in the question, if they don't mention when the lease payment is made, and one of the data may, if they say lease incentive is paid at the beginning, that means indirectly what they're trying to say is all the lease payments are not made at the end of the year. Lease payment has to be made also. All the payments in fact are made here at beginning of the year. Okay. Here, though they're talking only about lease payment, even if one component, if they use this for examination, keep this in mind. Okay. So if they don't tell when is the lease payment made, but one of the payments, like lease incentive in this case, they told it's made at the beginning. That means every payment you assume that it's made at the year beginning itself for exams. Okay. All right. Which is reviews for normal tenant improvement. Okay. AFG is reasonably certain to exercise purchase option. So lessee feels he'll go for purchase option. So simple. Initially, the lease term is 10 years. At the end of the lease term, lessee feels he'll buy off the asset. But he also has a renewal option. Sir, if lessee is buying off the asset at the end of 10th year means, should he have to renew this contract up? That asset only becomes his. That means where is the question of renewal? So renewal period and all here do not add, because any which way lessee is going purchasing the option, purchasing the asset. That is the reason. So how do you measure is what they're asking. Okay. So the first working note, I'll quickly show it off over here. First working notice, sir, you know that you have to show ROU and lease liability. How do you get lease liability? Present value of future. You get lease liability at present value of future cash flows. Present value of future cash flows. Discounted at what? IRR. If IRR is missing, you can use borrowing rate. Okay. So you have to take all the cash flows here. Okay. And do remember the payments are not at year end, payments are at year beginning. Okay. So first payment you will make is 5 lakh. then the discount factor is, the IRR is 1, discount factor is 9.04%. So don't do 1 divided by 1.0904 and take 0.92. No. First payment you will make it at the lease inception only. That means this is actually not year. In fact, if you are confusing, if you are that confusing, you always write in FM. You remember when you make the payment immediately, we used to call it as year 0. If you want, you can present like that. Okay, if you are of that confusion, all right, then you can put the next one as year 1. So year 0 means now, and this 5 lakh payment is made now only at the time of lease inception. So the discount factor is always 1. Keep that in mind. This is very important. Okay, because if this working is wrong, then every working that you're doing becomes wrong, because based on this only you do subsequent accounting. That's the reason. Okay, so this is that since the payment was at year beginning, and the first year ka discount factor is always 1. So multiply these two, you'll get the present value. Similarly, next year lease rental will be, it will not be same. It will increase by 3%. I think they told, no? Somewhere we saw, no? Lease rental increases by 3% every year. So 5 lakh plus 3%. 5 lakh plus 3%. 5 lakh plus 3% is your 5 lakh 15,000. But if you remember in the problem, there was one lease incentive also. When was the lease incentive paid? Immediately? No. Lease incentive was paid at the beginning of year 2, they told. Okay. So that means how much is the lease incentive? 2 lakh. Lease incentive should be reduced from lease payment. That means the lease payment for the second year will only be 3 lakh 15,000. Like that. The third year, don't take 3 lakh 15,000 and do 3%. No. The lease rental for second year is 5 lakh 15,000 only. Okay. 5 lakh 15,000 plus 3% you do, which you will get 530. Then again add 530 ka the 3% you will get. Like this, if you go on adding, you will get the respective years ka lease payment. Okay. Discount factor only first year ka you need to be aware, and then go on finding the discount factor for respective years. Future value multiplied by discount factor will give you the present value. So present value of summation, if you do, you're going to get 39 lakh. Actually, one thing they have not considered here, because we already studied what are those. Lease payment means, what are the components? Fixed payment, which we considered. In substance, fixed payment not there. Lease incentive, you should deduct, considered already. Then what's excuse me, variable payments based on index or rate, not there. Purchase price option there, but have they considered? Yes, they have considered separately. You don't put two tables. You are only consider at the year 10 May. Okay. How much is the purchase price? Purchase price will not be paid at year beginning. It will be paid at the end of the lease term. So which will be what? End of the lease term is 30 lakhs. So don't take the discount factor as 0.06. Sir, this 0.06 is 9th year ka discount factor, because all this payment is at 10th year beginning. This will happen at 10th year ending. So don't take 0.46. Again, press equals to button for discount factor. This will become 0.42. Just to make you aware of that, they're showing this as a separate table. You be aware of it already and show this calculation inside the table only. That means this will become 12.6 lakh. So you need to add these. Once you add this, I think they've only added here somewhere. In fact, about table, I think they've added. Yeah, they've added these two and they're saying 49 lakh 99,648. Approximately, they're rounded it off to 50 lakh. So present value of future cash flows is nothing but your 50 lakhs. So initially, ROU and lease liability both will be measured at same value. So you'll pass the journal entry. Asset, no. Asset, if you have to show, means the journal entry will be ROU, right of use asset account debit 50 lakh, to lease liability account 50 lakhs. That's the initial measurement. This is your initial measurement of ROU and lease liability. So subsequently, what do you have to do? ROU, you will depreciate. Over how many years? Sir, here, though, what is the lease term here? Lease term is only 10 years. But at the end of, you think practically, at the end of 10th year, what is happening? Lessee is purchasing the asset. That means he will get the asset usage only over 10 years. No. He'll be able to use this asset for its entire life, which is what? 40 years. That means this 50 lakh has to be apportioned or amortized over how many years? Not 10 years. Because if lessee did not have purchase option, you would have amortized it only over the lease term, which is 10 years. But here, since lessee is purchasing the asset, you'll amortize over 40 years. So the depreciation or depreciation will be 1,25,000 every year. What about lease liability? Sir, for lease liability, you have to put up ACM accounting. Normal, it's a financial liability, so you have to do ACM wala accounting. You remember that table, opening balance, yes, and interest. On lease liability, you have to book interest charges or finance charges, then payment, and finally closing balance. That table you need to book. But one thing you need to be careful over here is payment is not made at the end of the year. Payment is made at the year beginning. So whenever payments are made at the year beginning, doesn't matter. This approach is for here also, for normal ACM table, which you do in financial instrument topic also, it's the same. Whenever the payment is made at year beginning, first is usual. First take the opening balance. Opening balance of lease liability is 5 lakh. You think logically. On this, can I apply interest at 9.04%? No. At the year beginning itself, 5 lakh we paid off. No. That means liability ka value is really not 50 lakh. Though we recorded 50 lakh, immediately we settled 5 lakh because first lease payment is made right now. That means liability value is only 45 lakh. So indirectly what I'm trying to say, finance charges and interest column, no, you interchange. So don't, normally you used to write opening balance, finance charges, payment, and then closing balance. Don't do that. Interchange the column. First you write opening balance, then you write the payment, then you write the finance charges, then you write the closing balance. Okay. Deduct the payment and then calculate finance charges. Or if you want in between, you can bring in one more column. Opening balance and payment you do, and you'll get the revised balance. That's what they've done over here. From opening balance of 50 lakh, 5 lakh payment is already made. So that means the revised balance will be these two come minus, which will be 45 lakh. On this 45 lakh, you need to calculate interest at the rate of effective interest rate, which is 9.04%. And then you'll get the closing balance. So these two addition will give you the closing balance. First year ka closing will become second year ka opening. Again, you make the lease payment. Lease payment, no need to check the table again. Here, you've already written all the lease payments here. Just go on copying that one by one here. Okay. All the lease payments from working note number 1, you copy. Okay. You'll get the revised balance. On this, you apply EIR ka interest rate and you'll go on getting the closing balance. That is your initial account. That's all. Okay. The one thing you need to be careful here is, especially in lease, check when is the lease payment made, at the year beginning or at the year end. Okay. That is one thing. If any payment, if they say is made at year beginning, then assume that all the payments are made at year beginning itself. If one payment, if they say is made at year end, then assume all the payments are at year end, like this. Okay. Couple of problems. This particular trick has been adopted by study material. So you also follow the same thing for examination. Okay. So that's about initial measurement of lease liability, initial measurement as well as subsequent measurement. That's what I've written it over here. Okay. Fair enough, people? Okay. So initially, how do you measure ROU? Initially, ROU is measured at lease liability itself. In majority of our problem, in practical problem, ROU and lease liability ka initial balance will be same. But ROU, there are a few more components you need to add. Initially, ROU is measured at lease liability. If there is any payment made by lessor to the lessee before the lease commencement, before they made agreement only, if lessee has made some payment to the lessor, that will be added to the cost of ROU initially itself. Okay, that is one. If there is any IDC or DSR cost, IDC as in DAC, right? DAC you capitalize. No? Here, what asset is coming through lease? ROU account. That means excuse me, who's showing ROU? Lessee. So if lessee has incurred any initial direct cost, if lessee, not lessor, if lessee has incurred any initial direct cost, okay, like your brokerage, blah, 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 etc., then that will not be transferred to P&L, rather that will be added to the cost of ROU. And the same will get depreciated over whatever, over the lease term or useful life of the asset, depending on the conditions. Okay. Then if there is any DSR cost, rare, but if at all there is any DSR cost, add it up as well. So those provision will hold good. This you will do it initially only. So if you do all this, you will get initial measurement of ROU. But generally all this adjustment will not be there in the problem. That's the reason we normally say initially ROU and lease liability balance will be same. But if at all these are there, you need to add them also. All right. Subsequent measurement. Subsequent, we already know. ROU, either you can go for cost model or revaluation model. It's not cost of, it's cost or revaluation model. And then you have to depreciate ROU. From what date? Sir, you will start depreciation from the lease commencement date. From the day lease commences, from that day onwards, you will start. And you will depreciate it over how many years? You will depreciate it till the end of asset ka useful life. In this example, in this question, we depreciated the asset over 10 years. Even though the lease term was 10 years, we depreciated over 40 years. Why? Because lessee has an option to purchase the asset and lessee is reasonably sure that he will purchase it. That's the reason. So if the lessee has an option to purchase the asset and if he's reasonably sure that he will purchase it, then you will depreciate the ROU over the total life of the asset. Okay, that is one. Or sometimes what happens, lessor will be so Dharala Prabhu, Dharala Karna, he'll say that at the end of the lease term, Macha, you only take the lease. Lessor is telling the lessee, you only keep the asset. You don't have to pay anything. Keep it free, free, free. If that option is there, means in that case also you will depreciate the asset over the useful life, total useful life of the asset. Okay. Or in all other cases, if this purchase option is not there or if asset is not transferred, then you will depreciate the asset at the end of the lease term or life of the ROU, whichever is lower. So generally ROU life and useful life lease term will be same. Let's take a small example. Let's say lease term is 5 years, but ROU ka asset ka useful life is only 4 years. Asset ka life is 4 years, but you made a lease contract for 5 years. Lessee told the lessor, hey, asset will last only for 4 years, macha. But lessor told, if you want to enter into a contract, enter it for 5 years, otherwise get lost. Lessor is saying, lessor is hell bent to lease this asset only for 5 years. Even though the asset has only 4 years, very, very hypothetical. If that is the case, means you will depreciate the asset over 4 years in this case, because asset itself is lasting for 4 years. Okay. But generally, asset will have a longer life. This is very hypothetical scenarios. Okay. If at all this is there, you will have to apply. Okay. Subsequently, for lease liability, you will do ACM accounting. That means there are few expenses lessee will book. One is on lease liability, you have to book finance charges. On ROU, you have to book depreciation. If there is any variable lease payment made, you can call it as lease payment. But if it varies based on other factors, if it is not based on index or rate, meaning if it varies due to production, sales, etc., then such payments, no, it will not be treated as part of lease payment. Rather, it will be straight away booked as an expense by lessee, and lessor will book it as an income, like that. If there is any impairment of ROU asset, that also will book. So these are basically some expense which the lessee books in terms of lease accounting. Okay. Next what, sir? Excuse me, 1 minute. Okay. Think just 1 second. This is done. But I think we have a few more concepts. Then we will take that. 1 second. I'll do all this later. Okay. Sir, what if the lease is denoted in foreign currency? Okay. So if the lease is denoted in foreign currency, what to do? If you're making the lease payment not in Indian rupees, but let's say in dollars or euro or any other currency, then what to do? Okay, let's do a thing. Let's learn that with the help of a question only. Where is that? No, I think we'll learn that later. Once or maybe or do a thing, people. Let's do one more question on lease, and then maybe we'll take up the other things. Or there is one thing. Okay, let's do a thing. Let's put it on hold. We'll do it a little later. First, we'll do a little extra concepts. Then we'll come back to that. Remeasurement. As I told you, sir, initially when you're doing lease accounting, there are a lot of estimates. Whether you will purchase the asset or not, whether you will renew it or not, whether you will terminate or not. That means there are various estimates which lessee is doing, and the estimates can get changed. So if any estimates gets changed, that we call it as a remeasurement. So if there is a change in estimate, what to do is what this particular remeasurement concept is all about. This we learned it in the classes RRSGI. RRSGI. What is R? Remeasurement due to exercise or not exercise of extension or termination option. Okay. Initially, the lessor thought that he will go for termination option. Later, he realized he will not terminate. Initially, lessee thought that he will go for renewal option. Later, his mind changed and he's saying he will not renew the option. That is the first one. Second R is for reassessment of purchase or of exercise or not exercise of purchase option. Initially, lessee thought that he will purchase the asset. Later on, he changed his mind and is saying he will not purchase the option because a certain circumstance, technology, etc., changed. That is second R. S for change in in-substance lease payment. If there is any change in the in-substance lease payment component, what to do? Then G for change in guaranteed residual value. I for change in the index or rate. So if these things are there, means how the lease accounting will change is what we are trying to say. Sir, these two are usually within lessee control. Hence the standard is saying if there is any change in estimate due to these factors, you have to use new rate as a penalty. Okay, you can't continue with old discount factor. You have to use new rate because these two are generally within the lessee. Thought process maybe is that. That's the way you can remember. That's the way I remember. If you want, you can remember like that. So first two R was within the lessee control. So if lessee changes this as a penalty, you have to use new rate. For the last three, it was kind of little outside because it's based on other factors. That's the reason you continue with the old rate only. Okay. So whenever there is a change in estimate, you don't book any gain or loss. Adjustment will be done in ROU itself. Okay, no gain or loss on remeasurement is accounted, but the revised amount is adjusted in ROU and lease liability itself. So how, sir? Let's understand with the help of a question. Let's take up question number 32. Excuse me. Entity W enter into a lease of a retail store with entity J. So entity W enter into lease contract means they are lessee and entity Z is the lessor, and the lease commencement is 1st January 2017. Initial term of the lease is 5 years and there is a renewal option of 3 years. Annual lease payment for initial term is 1 lakh, renewal term is 1,10,000. For first 5 years, lease payment is 1 lakh, then it is 1,10,000. So it is varying. No. Lease payment, when we say lease payment should be fixed, it's not necessary it should be fixed for the entire term. Even if it is fixed for a certain duration. Here, for 5 years, it is fixed. No, that means we say that lease payment is fixed only. Okay. Even if it is fixed for 6 months or 1 year, still it is a fixed payment only. It is not variable payment. Okay. The annual lease payment will increase based on the annual increase in CPI. So the lease payment will going forward may increase based on consumer price index they're saying at the end of preceding year. For example, payment done on 1st January will be based on CPI 1 day before. So based on 1 day before ka CPI or year ended ka CPI, the next year ka lease payment will change. Okay. Excuse me. The lessee ka incremental borrowing rate at lease inception is 5% and 6% respectively. The lessee's incremental borrowing rate at lease inception date and as at 1st January 2020. At least inception is 1st January 2017 and that rate it was 5%. On 1st January 2020 it has become 6%. That means something else will happen on 1st January 2020. Yeah, let's see. Okay, and the consumer price index on the same day they've given at least inception 120, later on 125. At the lease commencement date, entity W did not have significant economic incentive to exercise renewal option. At the lease inception, lessee was not sure. Lessee didn't have any incentive to renew it. That means the lease term will only be 5 years. In the first quarter, however, 2020, we don't know 2020 something happened. Yeah, this entity W installed a unique lease improvement in the retail store with an estimated 5-year useful life. And entity W determined that it would only recover the cost if it exercised renewal option. So few things changed. We did some lease improvements. Now we are saying because we spent some extra cost, we'll be able to recover the cost only if we renew the lease term. Otherwise, we will not. So initially, lessee didn't want to renew it. Now they want to renew it. Okay. So that's what has changed over here. Okay. So what about the remeasurement is what they're asking. First, sir, what is happening here? So, excuse me. All right. Sir, on 1st January 2020, initially on the lease inception date, consumer price index was 120. But on 1st January 2020, it has become 125. That means the consumer price index has changed. So change in the index, we already studied that. We use old rate. Yes, RRSGI. Okay. I for R for remeasurement of exercise or not exercise of renewal or termination option. Another RR for reassessment of purchase option. Okay. Third for change in insubstance lease payment. G for guaranteed residual value. I for index or rate. Here index is rate. Index is change. So if there is any change in the index, we will use old rate. But at the same time, even your renewal option has changed. No, initially you didn't have an incentive to renew. That means we did not take renewal period. Now we have incentive to renew. So renewal period is also changing. Whenever there is a change in renewal period, we have to consider new rate. Yes. So it means for one component, we have to consider old rate, another one for new rate. Like this, if there is controversial. So check any which way we need new rate for RR. No. For entire thing, we will do only new rate. So even for one component, if you are using new rate, then you will do the whole accounting using new rate only. So this is irrelevant for us. We will only use new rate. Okay. So first, the change happened on 1st January 2020, but lease you started on 1st January 2017. So 17, 18, 19. Okay. So 3 years are there. I think we studied there somewhere at the payment, somewhere they said, beginning, anything is there, just check. No, we have not seen anything there, no? Excuse me, or they've taken beginning, somewhere is there a beginning. Okay, here's this is the clue. The payment due on 1st January. This is the clue. The payment due on 1st January. Sir, here the year is beginning on January. Okay, that means year will end on December. If they give the data on January and if they don't tell anything, the year will end on December. Okay, and you are making the payment on 1st January means you are making the payment not at year end, you are making the payment at year beginning. Keep that in mind. Okay, so that is important in these factors. Okay, here also the payment is at beginning. If one factor, if they use the word beginning, then all payments at beginning only. Okay, so first, so that means you take the lease on 17, things are changed on 20 in fact. So 17, 18, 19, 3 years have already passed. Then only something has changed. So first, let's do the initial measurement and find out what is the lease liability on the remeasurement date. When the estimate changed, what was the lease liability balance? First, let's find out that. So working note number 1 we will put up is the initial lease measurement. They must have given somewhere here. Here. This is your working note number 1 for initial measurement of lease liability. How do you initially measure lease liability, sir? Present value of future lease payments. Yes. Present value of future cash flows. So initially was lessee sure that he will renew it? No. That means you will take the lease term as how many years? Only 5 years. And what is the lease payment? 1 lakh. Okay. Sir, index you have to change. No. Sir, index you don't have to estimate because index is based on, it's a country based index. So lessee will not be in a position to estimate what's going to be the index. Okay. Whatever is the index on that day, you use that and accordingly do it. Okay. So what was the lease payment initially? 1 lakh. So we'll assume that the same amount, index will remain the same and lease payment also will be 1 lakh for all the 5 years. Take 5 years only. Only later on, if index changes, lease payment also will change. But initially, when you are doing lease liability while accounting, you don't have to estimate. Lessee doesn't have to estimate what's going to be the country ka index over the next 5 years. No person will have that capability. Okay. All right. So these are all your lease payment. But do keep in mind, I think they've only given the discount factor as 5%. Incremental borrowing rate we are using. But discount factor for first year, don't do 1 divided by 1.05. The payments are at year beginning. Okay. So they have already given here year beginning. That means first year you will take discount factor as 1. Then do the other things. You will get for present value of future cash flows or present value of future lease payment is 4,54,600. So initially you will pass the journal entry ROU account debit to lease liability. There is no IDC, there is no DAC and all. So ROU and lease liability initially will be same. So this is the first year or initially when you take on the lease commencement date. Okay. Initial measurement of ROU and lease liability will be this. Thereafter what will happen? ROU will get depreciated. On lease liability, you have to put up ACM table. So this is what they have put. This is the lease liability account. Okay. Since the payments are at year beginning, I told interchange the column. So first it will be year opening balance, payments, revised balance, and then finance charges, and then closing balance. Here I've not put revised balance. If you want, you can bring it in. Okay. So initially, lease liability ka value is 454,600. When you got into a lease, only 1 lakh payment you will make. That means the amount remaining is what? 454,600 minus 1 lakh. If you do, you're going to get 354,500. Of that, you multiply into 5% EIR. The interest will be 17,725. They rounded it off to 17,730. The closing balance will be this minus this plus this, which will be 372. Like this, go on finding it out. Don't need to put up for 5 years because after 3 years, some data change. No? So at the end of third year, what is lease liability ka value? 195,244. Similarly, ROU will be depreciated over how many years? Let's say you didn't have an intention to renew the asset. That means you'll depreciate the ROU over 5 years. That's what they've given over here. So the closing balance of ROU is 181,840. So when you did, whenever this estimated changed or this remeasurement came, lease liability has a balance of 195 and ROU has a balance of 181. Okay. Now, what estimate changed? Now, sir, 5 years, 3 years of lease term already over. 2 years is still pending. Yes. Now, what is the lease telling? Since we incurred some cost, now we have to renew the option. That means on the original lease, the term remaining is 3 years. We'll also go for renewal option of how many years? 3 years. That means now still 5 years of lease rental is still pending. Okay. So that is what we are seeing. That is one. So that means the lease term from initial 5, if you calculate total lease term will not be 5 years. It will be 5 plus 3, it will be 8 years. So lease term has changed. Okay. Now what you have to do is, you have to find out the revised. How did you find out lease liability ka balance now? Present value of future lease payment. Now, because the term has changed, the old lease liability will not hold good. Because you have renewed the lease for 3 years means you have to pay extra rent. No. Initially, when you found out liability you found out by keeping only 5 years as a lease term. Now, 5 years is not the lease term, 8 years. So that means old liability will not hold good. The liability will increase because you have renewed it for 3 years means you have to pay extra lease rental. So liability value obviously will increase. Yes. So we have to find out that. How do we find it? Same measure. Initially, how did you find out lease liability? Present value of future cash flows. Now also you do the same thing. Find out the present value of future cash flows remaining. 5 years future cash flow is still remaining. Find it out. But don't take lease payment as 1 lakh now because they said index also changed. And the commencement date, no, on the lease commencement date, consumer price index was 120. Now it has become 125. Meaning 1 lakh was the lease rental when consumer price index was 120. Now on 1st January 2020, on the estimate change rate, consumer price index has become 125. That means lease payment will not be 1 lakh. It will be different. What is that? So basically 1 lakh into 125 divided by 120, that will give you. So lease payment will be 104,167. This is for the 2 years because originally lease term was 5 years. No, now 3 years is already over. For the remaining 2 years, lease payment will be this much. What about renewal, sir? Initially, if you want to go for renewal option means in the renewal period, the agreement said that you have to pay a lease rental of 1,10,000. Sir, 1,10,000 was the lease payment when the consumer price index was 120. Now is the consumer price index 120? No, it has become 125. So this also will not be 110. It will get revised. So it will be 1,10,000 into 125 divided by 120. Now the lease payment in the renewal period will be 583. So this is for the remaining 3 years. For the first 2 years, it is 104,367. That's what they've taken here. For the remaining years, it is 114,583. That you have to take. Okay. This is the payment you have to make. This is your future cash flows. Discounted. At what rate? Don't use old rate. Estimate change, no? So that means you have to use the new rate. So when the estimate change, I think they've given. On the lease inception, the rate was, incremental borrowing rate was 5%. On 1st January 2020, when the estimates changed, the rate has become 6%. So discount this at 6% now. And you'll get the present value of cash flow to be 491,376. So this is your new lease liability wala balance. So the new lease liability, or I call it out like this, required lease liability balance. If you want, you can write revised or you can write required. Required lease liability balance is 491. But how much is existing? Check your ACM table. That give you the balance. Existing balance is 195,244. Required is 491. But currently your liability is only 195. Since you renewed the lease term, obviously lease liability balance will increase. Currently, you're showing it at 195. It has to be 491 means lease liability balance you need to increase by how much? 296,132. Okay. Sir, do remember whenever there is an estimate change, gain or loss you will not book. This adjustment will be done in ROU. You have to increase lease liability. You will not only increase lease liability, you will also increase ROU. There is an estimate change. So that means the journal entry you will pass is you have to increase your lease liability by 296. Lease liability is a liability which has credit balance. Correct. Okay. It already has credit balance. Again, if you have to increase means you have to credit again. So lease liability you will credit. What will you debit? ROU. So the journal entry you will pass for this remeasurement is ROU account debit to lease liability 296 132. So currently it was shown at 195. You increase it by 296 so that its balance will become 491 376. So no gain or loss should be accounted. So this particular adjustment has to be done in ROU and lease liability itself. So that is the thing. Okay. Great. So that's about your remeasurement wala accounting. That's what I've called out in the chart over here. Where is it, Pa? 1 second, sir. Yeah, this is what we applied in this particular case. Okay, great. Next, one more thing is remeasurement is one important aspect for exam. Another important aspect for exam is lease modification. This is also equally important. Okay, lease modification. Sir, lease modification means what? Sir, if the lease term has increased or decreased. Initially, let's say the lease term was 10 years, not renewal and lease term was 10 years. You modified it to 20 years or 15 years. So lease term has increased, lease term has reduced, or a new asset has come in. Initially, let's say you took only one floor of the building on lease. Building ka only one floor you have taken on lease. Now you modified this lease, you amended the lease and took one more floor on lease. That means 2 floors you have taken on lease. That is the lease modification. So if an new asset has come in or asset value has reduced, earlier let's say you had taken 3 floors of building on a lease. Now 1 floor you cut off. That means the remaining is now you have only 2 floors ka lease rental. So like this. This is a lease modification. Or if a lease payment has changed. Let's say lease payment was 1 lakh every year. Now you made it as 1,50,000. Okay. Or you increase the lease payment or you reduce the lease payment. Or lease payment initially you were paying at the end of each year. Now you made it as beginning of each year. So all this, if you are changing, that we call it as lease modification. Okay. So don't confuse lease modification with remeasurement. If you want to identify a trick, whenever there is, in the problem, if they use the word amendment is not estimate changed. Okay. If you see the word amendment, it means it's a lease modification. So for lease modification, you have to do slightly different accounting. So just be careful in that. Okay. All right. So, sir, lease modification, no? Okay, the keyword is look for the word amendment. Whenever they use the word amendment, it means lease modification or not remeasurement. Some part of accounting between lease modification and remeasurement are same. I'll come to that in a bit. But the clarity of this is look for this word and accordingly decode what it is. Okay, so whenever you have done lease modification, it could lead to a separate lease or not a separate lease. Lease modification could lead to a separate lease or not a separate lease. So, well, sir, if you want to call it as a separate lease, if you want to call lease modification as a separate lease, 2 conditions should be satisfied. One, an extra asset should have come in. That extra lease component should have come in. One or more, not just one or more ROU or lease component should have come in. And second, sir, like here, let's say we have taken 1 building on lease rental before. Now you added 1 more floor. That means extra floor is coming in. That's what this condition is trying to say. 1 or more ROU should come into your lease agreement for you to account it as separate lease. That is first condition number 1. And obviously, sir, let's say earlier you had only 1 floor. You are paying a lease rental of 1 lakh. Now you have 2 floors. Can you pay the same lease rental or you have to increase now? Obviously, there will be an increase. The increase in the lease payment should be it should be at par with standalone selling price of that additional lease component. Meaning, now you have taken extra floor on lease rental. No? Let's say for this, you are paying 1.5 lakh rupees because it is little bigger in space. Let's assume ground floor little smaller. First floor is little bigger, let's assume. So you are paying a lease rental or lease payment of 1.5 lakh rupees. What the standard says is, if you want to account this, right now you have ground floor, now you have taken first floor. So you have done lease modification, contract modification you have done. So this first floor, you can treat it as a separate lease. You can account this separately. You don't have to mix this with ground floor. Ground floor ka lease accounting you can do separately. First floor ka lease accounting you can do separately. If you want to do separate lease accounting for first floor, 2 conditions should be satisfied. 1, new asset should have come in, which obviously first floor has come. So new asset has come in. Second one, the increase in the lease payment should be at par with the standalone selling price of that additional lease component. What does that mean is, for this first floor, how much are you paying? 1.5 lakh. Suppose you didn't have ground floor. You took only first floor on lease. How much lease rental you would have paid? Let's say you would have paid lease rental of only 1.5 lakh. Now also how much you're paying? 1.5 lakh. That's what they mean by that. Meaning the first floor, you should have taken it on rent at market price. Because you have taken ground floor on rent, you should not get any discount on the first floor rent. The price that you're paying for first floor should be as per the market terms is what they're trying to say. That's what we mean by it should be at par with standalone selling price. Meaning if you had taken only this first floor on lease, how much rent you would have paid, only that much you need to pay due to this modification is what they're taking. Basically, the rent has to be as per market terms. If that is the case, if both these conditions are satisfied, ground floor ka lease accounting, you do it separately. Whatever you're doing, continue with that. No need to change anything. First floor ka lease accounting, you treat this as two separate lease. This is a separate, first ground floor is a separate lease, first floor is a separate lease. So do separate accounting. That's what we mean by this. That means for first floor, you're treating a separate lease means again you have to account one more RU and one more lease liability, and that particular cycle continues like that. This is for separate lease. This most probably will not come in examination because this is very easy. Okay, the more popular one is this. You have done a modification, but the modification does not lead to a separate lease. If you want to call it a separate lease, new asset should have come in. Remember the condition. They will not tell you. They'll simply say lease is amended. You need to decode whether it leads to a separate lease or not a separate lease. For that, you need to know the condition. Yes. So if you want to account it as a separate lease, one new extra component should have come in, and the increase in the lease payment should be as per market terms. Okay. If both of this condition or any of this condition fails, for it to be a separate lease, both of them should be satisfied. Even if one fails, then you can't account it as a separate lease. Then how should we account, sir? Two possible scenarios. Sir, it is not a separate lease, and check if it is a decrease in scope, or it is not a separate lease and not a decrease in scope. It's not a separate lease, but check in the, whether that lease modification will lead to a decrease in scope or no decrease in scope. Okay, first we'll do no decrease in scope, one problem. Then we'll go for one problem on decrease in scope. These are important for examination. Excuse me. Okay, so I've written some words. Maybe if you wrote, may not get it right away. So let's do a thing. Let's directly go into the problem. 1 second. Which one I'll see? 1 minute. First, I think we will do this question. Question number 34. Lessee enters into a 10-year lease for 5,000 square meter of office space. Okay, one office space we have taken it on rent for 10 years. Annual lease payments are 1 lakh payable at the end of each year. So clearly given payment at the year end. Interest rate implicit in the lease cannot be readily determined. IRR cannot be determined. So obviously you will use lessee ka incremental borrowing rate, which is given to be 6%. At the beginning of year 7, so things went smoothly till end of year 6. Lease term was 10 years. Till 6th year end, everything went smoothly. At the beginning of 7th year, some Shani, Rahu, Ketu, something has happened. Something have changed. Let's see. Lessor and lessee agreed to amend the original lease. So they've decided to amend. So that means this is a modification. Not an estimate change. This is a modification. Okay. They amend the original lease by extending the contractual lease by 4 years. They want to extend it by 4 years. That means the lease term, total lease term will not be 10 years. 10 plus 4, it will become 14 years. Like that. So the annual lease payments are unchanged. So whatever lease payment you are paying initially, same lease payment you will pay for the extra 4 years also. Okay, 1 lakh payable at the end of each year from year 7 to year 14. Lessee ka incremental borrowing rate is 7%. Obviously, the rate will not be. Initially, the rate was 6%. After 6 years, the rate would have any which way changed. Now the rate has become 7%. So you need to say how this modification should be accounted. Okay. All right, great. So first thing is, even if you don't do modification, if you don't know, okay, even if you don't know a thing about modification, you can use still common sense and get 2 to 3 marks. What is that? Sir, modification happened when? At the beginning of year 7. I mean, still year 6, everything was smooth, no? So initial measurement of lease liability is same. You can find out lease liability at the end of year 6. That accounting anyway, nothing has changed. First, at least put that up. Okay, in case you have not done. Ideally, you should not skip things. But in case you have skipped things, okay, if you don't know anything, still no, sir, even in the question which are entirely new for you, some portion of those questions will have the common things only. At least try to solve common things. Don't skip things entirely. Like if you solve that much, at least 1 or 2 marks you will get. Like that. Okay. Okay. Thank you so much, Gaurav. You've cleared your CA final exam. Huh? Wonderful. Okay. Thank you so much for dropping by and sending that message. Awesome. Thank you so much. Yeah. For now, I'll continue, but yeah, we'll talk for another day. If you're free, come down to the academy. I would love to meet you in case you are in Bangalore. Yeah. All right. Excuse me. So how the modification should be accounted for? Now let's go back. Let's go ahead with this. First, the modification has happened at the end of year 7. So first, let's do the initial measurement of lease liability. So how do you get initial measurement of lease liability? Simple. Present value of future cash flows. Institute, I don't know why, for God's joy, they put a full table. Sir, lease payment is same every year, no? Correct? If lease payment is same every year, we can use present value annuity factor, sir. So why should I put up so big table? Simply take lease payment and multiply it by PVAF, present value annuity factor. What was the initial discount rate? Initially it was 6%. Okay, for how many years? For 10 years. For 10 years at 6%, if you find PVAF, that will be 7.36. So 1 lakh into 7.36 will give you 7,36,000. Same answer. But why to waste so much of time? So this is the initial measurement of lease liability. ROU also initially it will have the same balance. Yes, no? Because there is no IDC, there is no DAC, no payment made by the lessee to the lessor before lease commencement. If those are not there, means ROU and initial value of lease liability will be same. So this is the accounting. Okay, then what? ROU will be depreciated over 10 years because there is no option of purchasing here. And then lease liability, you have to follow ACM accounting. So let's put up this your ACM table. Okay, this is your normal thing because payments are made at year end. Okay, so opening balance, finance charges at effective interest rate of 6%, then lease payment and closing liability. So initial value of lease liability 735,900. Interest charges of 6%, you calculate 735,900 ka 6% and deduct 1 lakh a lease payment made every year, you will get the closing balance. Like this you do it. No need to put up for 10th year because any which way we know at the end of 6th year terms have changed. So do it on only 6 years. That is good enough. So at the end of 6th year, lease liability ka closing balance is 3,46,355. Okay. Similarly, ROU also if you want you can do it. Where is that ROU they have done? Actually, ROU is not required over here because there is not a decrease in scope. Even if you do ROU, not a big deal. Okay. But that working note is not required. I'll tell you at the end. Okay. Now at the end of 6th year, till here everything was smooth. 7th year, what happened? 7th year, what happened? You did a modification. First of all, we did not check whether this modification is a separate lease or not a separate lease. Can you tell me? This is absolutely not a separate lease. Why, sir? Sir, only term has increased. For you to account it as a separate lease, a new lease component should have come in. Has a new lease component come in here? Did earlier the building, the asset you have taken on lease had as 5,000 square meter. Now extra square meters came in as lease? No. So no new asset is added. That means if any one condition fails, it cannot be treated as a separate lease. That means this is not a separate lease wala accounting. Okay. Did we reduce or decrease in scope means we have reduced the building. Earlier you had 2 buildings. Earlier you had 2 floors. You have taken it on lease. Now you have only 1 floor. That and all we call it as decrease in scope. Have you decreased the scope here? No. That means what? This modification does not lead to a separate lease and it is not a decrease in scope also because we have not reduced any asset. If you are reducing any asset, we call it as decrease in scope. Here reduction has not happened. Okay. So in this case, what you have to do is simple. Excuse me. Obviously, sir, you have extended the lease term. No. Initially, the lease term was only 10 years. Now you have taken it till 14 years. So if you have extended the lease term, means will the lease liability be same? No, obviously lease liability, if you have extended the lease term by 4 years means you have to pay 4 years extra lease rental means your lease liability value will be more. That means you have to find out what same like remeasurement, you have to find out new or revised lease liability. So how do you find out revised lease liability? Same. Present value of future cash flows remaining. Now you are at the end of year 6. Year 7, year 8, year 9, year 10, 11, 12, 13, 14. For 8 more years, you have a future cash flows. Okay. Find out the present value of future cash flows. Not by discounting at old rate, by discounting at new rate. For lease modification, you will only use the new rate, not the old rate. So discount them at the new rate. That's what it is. That is your working note number 3. Finding out the revised lease liability wala balance. Okay. But by using new rate, which is what, sir? 7%. And lease payment they told is unchanged. 8 years payment is still remaining. That's why they put 1, 2, 3, 4, 5, 6, 7, 8 if you just check there. Year 7 to year 14. Okay. Discounted at 7%. If you multiply, you're going to get the present value of lease payment to be 597,100. So the required lease liability balance after modification is, this is after modification. Required lease liability balance after modification is 5,97,100. That is required. But what is existing? Existing lease liability balance. Existing lease liability balance, your amortization cost table will give you. Amortization table we already checked over here. Existing lease liability balance is 346, 355. Okay. So required is this much, but existing is only this much only. That means lease liability value you need to increase. How much you need to increase it by? 597,100 minus 346, 355. 355 if you do means you're going to get 257.45. So lease liability balance you need to increase, right? So lease liability as credit balance. How do you increase it? Again, credit it. Again, this adjustment is same like remeasurement adjustment. How did you do remeasurement adjustment? ROU account debit to lease liability. So that means for this 273.45, you'll simply pass the journal entry ROU account debit to lease liability. So you will not pass any gain or loss. So if there is no decrease in scope and if there is any modification, that means remeasurement accounting and modification accounting, same, no change. But only use for remeasurement mode, for the first two factors, you can use the new rate. Last three factors, you will use old rate. Yes. Okay, rather for the first two new rate, last three old rate. Here for modification, everything at the old new rate itself. Okay, for modification, when you're finding out new revised new lease liability, you will always use the old rate. That's only distinguishment factor. But the final adjustment is same. Okay, if there is no decrease in scope, no gain or loss will be accounted. So whatever is the difference, you will adjust it in ROU only. So the journal entry will be ROU to lease liability. Suppose you have to decrease the lease liability, rare, but if at all it is, then ulta entry. Lease liability account debit to ROU, whatever. If you have to increase it, this entry, decrease it, mean ulta entry, whatever you get. Okay. So that is your lease modification where there is no, it is not a separate lease and there is no decrease in scope. So if we'll have to sum it up, what is it simply? Find out on the modification date, what is the existing lease liability balance. Your ACM table will give you that. Then what's the, find out the revised lease liability balance. How do you find out the revised lease liability? By finding out the present value of future cash flows, but by discounting at new rate. That's all it is. Okay. So the difference, but the revised lease liability and existing lease liability, the difference you have to adjust it in ROU by passing this particular entry, ROU account debit to lease liability. No gain or loss will be accounted. Okay, that is the point. Okay, another scenario is this. It is not a separate lease, but it has led to decrease in scope. If there is a decrease in scope, means what to do? Decrease in scope means, let's say you had 2 floors earlier you had lease, now 1 floor you have cancelled and now only 1 floor is remaining. Or you had 5,000 square meters of building space. From 5,000 square meter of building space, some portion you told the lessor, I don't want it. Now you want only 2,000. From 5,000, you have reduced it to 2,000. That means 3,000 square foot or square meters ka office space you have cancelled. Okay, so that is what we mean by decrease in scope. Decrease in scope means asset value has reduced. Okay, current of people or lease term also has reduced. Both. Okay, the decrease in scope means scope is the lease is this. Asset has reduced or time has reduced. Lease term, if it is reduced, also means it is a decrease in scope only. That's what I've written it out here. Okay. So in this case, how to do the accounting? Let's learn it with the help of one question. I think we have question number 35 for it. I think, yeah, we'll go for 35 people. Excuse me. These looks lengthy, but once if you practice it, these are very, very straightforward question and pakka format you have. Aram se you can do it. The only crux here is once you need to practice to get the overall crux of the format. Another one is the challenging part is to finish all these papers within like that 15-20 minutes tops. So you need your handwriting speed really should be good. That you need to work upon. Okay, that's the only crux. Otherwise, these are quite quite simple ones only. But first time if you have not studied this and if you flip through the pages, many students will skip only. Oh, your 4 or 5 pages ka solution. Who will do so much? They put so many tables. Okay, so much of journal entries. Who will do and all that? But once if you sit through and just go through that, that's a very, very straightforward wala question this is. It is lengthy but very straightforward. Okay. Lessee enters into a 10-year lease for 5,000 square meter of office space. Same. The annual lease payments are 50,000 payable at end of the each year. Okay, great. IRR cannot be determined. So lessee ka incremental borrowing rate on lease commencement is 6%, same as last problem. At the beginning of year 6, again, till 5 years, things were smooth. At the beginning of year 6, some drama happened. What happened? Lessor and lessee agreed to amend. Amend means not estimate change. It's a modification. Okay. They have agreed to amend the original lease to reduce the space to only 2,500. Sir, existing space was 5,000 square meters. Now the revised space is only 2,500. From 5,000, it became 2,500. That means asset is increasing or asset is reducing. Asset has got reduced. Sir, if asset has reduced, means this only we call it as decrease in scope. If either asset has reduced or lease term has reduced, that's what we mean by decrease in scope. If there is a decrease in scope, you think logically. If asset has reduced means some part of the asset control you have lost. Correct. Now earlier you were able to control 5,000 square meters. Now you are able to control only 2,500 square meters. So some portion of the control you have lost means indirectly it's what, sir? Some portion of the asset you have sold. You can think like that. So whenever there is a decrease in scope, people, you have to book some gain or loss. There will be some gain or loss. Okay. Only in decrease in scope, there will be some gain or loss, which you need to find out and account it. How to do? We'll learn it with this problem. Okay. So now only 2,500 square meters is there. Starting from the end of the first quarter up to year 6. Okay. So till year 5, we had 5,000 and thereafter we are having only 2,500. The annual fixed payments from year 6 to year 10 are 30,000. So obviously, you were paying 50,000 lease rental for 5,000 square meter. Now you have only 2,500 square meter. So you will not pay the same rental. Rental would have reduced. It has become how much now? 30,000. Let's see the incremental borrowing rate at the beginning of year 6. On the day it got modified, now the new rate has become, this 5% is your new rate, 6% is your old rate. Okay, I already told you modifications and all, everything is done using new rate. Okay, keep that in mind. So how should the said modification be accounted? Same thing, people. Modification happened at the beginning of year 6. I mean, still year 5, no change. So first do the initial measurement. How do you find out the initial measurement of lease liability? I think they've already done here. Initial value. Again, they put, sir, lease payment is same every year. You have to calculate it 10 times. Oh, no, you can use PVAF. No, simply take lease payment and take present value annuity factor at 6%. Old rate this is. Okay, don't take here new rate. Huh? Okay, this is initial measurement. So initially the rate was only 6%. Old rate was 6%. I've showed it to you here. Huh? So use PVAF at 6% for 10 years. So 50,000 into 7.36 if you do, you're going to get 3,68,000, which they've taken it as 367,950. Okay, that's the first thing. Thereafter, what will happen? ROU will get depreciated over 10 years. On lease term, you have to put up ACM table. That's what they've put it up here. We'll quickly see. This is your working note number 2 for lease liability and ROU ka balance. Lease liability, same drama. Year opening balance, finance charges at 6%. Then lease payment and closing balance. So they've interchanged the order. No. They've interchanged the order but calculated lease interest expense currently. Check here. Opening balance is 367,950. On this only they've calculated 6% interest. If you want to check. This they've named it as A. How do you get C? A multiplied by 6%. Don't worry about study material ka presentation. One problem they'll present one way. So you keep your presentation aspect clear. So basically 367, this one. 367,950 into 6% if you do. My calculator is showing 22,077. That's what they've taken it as interest. They've not reduced this. Okay, they've just interchanged the column, but interest they've calculated properly. You don't have to do so much of harkate. Okay, so you book first opening balance, then interest, then payment, and then closing balance. Find it out. So you don't have to put it for 10 years because we know that anyway after year 5 things have got modified. So only till end of year 5 you do. So existing lease liability balance is 2,10,546. Similarly, ROU also will get depreciated over 10 years. So every year, how much depreciation? Same depreciation you'll get. So the end of 5th year, ROU ka balance is 183,975. So working note number 2 gives you this. Okay. Now simple people. Now you've got ROU ka balance on the modification date and lease liability ka balance on the modification date. What sort of modification is this? It's a decrease in scope. Correct? It is not a separate lease and it is a decrease in scope. How? Because earlier we had 5,000 square meter of space. Now we have only 2,500 square meter. So that means, can I say 50%? Because 5,000 ka 50% is how much? 2,500. 2,500. Not only they gave it over here, right? So 2,500 square meter ka space, we have lost control. Can I say so? Correct. So that means 50% if you have lost control means what you simply need to do is check. I've shown over here. I already told you whenever there is a decrease in scope, you need to book some gain or loss. First, take what is the existing balance of lease liability and ROU on the modification date that we have got it over here. I've listed it out here. On how much have you lost control? 50% asset you have lost control. So 50% if lost control means ROU balance will have to be reduced by 50%. So if ROU itself is not there means on ROU only because you have asset, you have a liability. Correct? No. If asset is reduced by 50% means liability ka balance also will reduce by 50%. So take this number 210,546 lease liability, calculate 50%. So 50% you have to reduce. After reduction, what will be? 105,273. Okay, like that. ROU also 50% you need to reduce. 91,987. Why 50%? Because they've given in the question from 5,000 it became 2,500. Hence, the decrease in scope is to the extent of 50%. So 50% of lease liability and 50% of ROU has to be reduced. So lease liability is a liability which has credit balance. How do you reduce it? Debit it. ROU is an asset. It has debit balance. How do you reduce it? Credit it. So the journal entry will be lease liability account debit to ROU account. Lease liability you will debit by 105,273. ROU you will debit by 91,987. Is the journal entry matching? No. The difference is nothing but your gain or loss. Difference is coming on the credit side. That's the reason you're booking as a gain. Or think logically, liability is getting reduced by 105. Asset is getting reduced by only 91. So liability is getting reduced more. So when liability is getting reduced more means obviously it's a gain. So that gain is transferred off to P&L. Okay. This is your decrease in scope. Ka gain transferred off to P&L account. Okay. That's your account. Okay, ba? Yes, sir. This is one. But whenever there is a decrease in scope, right? There will be some remeasurement gain or loss also, sir. There will be remeasurement gain loss also. Why, sir? Sir, currently you have calculated lease liability and all. You have calculated all this. How? By keeping the lease payment as 50,000. You got all this value by keeping the lease payment as 50,000. Is the lease payment really 50,000 now or it has become 30,000? Now the lease payment is not 50. You have calculated the liability by keeping lease payment as 50,000 every year. Now the lease payment is not 50,000 every year. It is only 30,000. That means, do you think this liability will hold good? No. That means what? Liability again will change. That means what you have to do? Again, you have to find out the revised value of lease liability. So how, sir? Present value of future cash flows remaining at new discount rate. Present value of future cash flows remaining at new discount rate. That's what they've given over here. This is your revised new annual balance after modification. Basically, remeasurement gain or loss for which you will use new rate. So when did you do modification? After 5 years. What is the lease term? 10 years. So that means year 6, year 7, year 8, year 9, year 10. So 5 years ka lease payment is still remaining. Lease payment is not 50 now. Lease payment is only 30,000. So take the lease payment as 30,000 and take the new rate. What is the new rate? After modification, the new rate has become 5%. So discount it at 5%. You will get 1,29,900. So the revised lease liability is 129. But after you did decrease in scope, no, lease liability ka balance is 105. 50% you reduce, no? After 50% lease liability balance has become 105. Required is 129, but currently you have 105. That's what I've written here. Lease liability balance after modification should be, or in fact after modification it is 105, but required is how much? 129. Required is 129, existing is only 105. That means lease liability balance from 105 you have to bring it to 129. So lease liability balance you have to increase by how much? 24,627. This is your remeasurement gain or loss. Remeasurement gain or loss you don't transfer it to P&L, but adjusted in ROU. So lease liability you have to increase means ROU also you will increase. So the journal entry you will pass for this is ROU account debit to lease liability account 24,627. So from examination perspective, this is better. Why? So whenever there is a decrease in scope, so there will be decrease in scope ka gain loss also, which will be transferred off to P&L, but there will be some remeasurement gain or loss also that will be adjusted in ROU. So in a way they can test both. If they give you a decrease in scope, remeasurement concept also they can test, and decrease in the gain loss concept also they can test. Hence probably I would say this is a little more popular in examination, or examiner would probably pick this. I don't know whether it will come or not, but I'm just saying this is better suited for examination. Okay, so that's about this concept. That's what I've called out in all this chart there. Whatever we did right now, I've just called it out in the words there. So if you don't have time on the examination day to solve any questions, you can run through these pointers. If you have clarity, yes, these pointers will make sense. Okay. So this is done. Move on to the next one then. Okay. 1 second. Excuse me. Okay. So till now we have done lessee ka accounting. Now we're talking about lessor ka accounting. As far as my memory goes, lessor accounting ka, we don't have any questions in study material. But in our regular class, I had shown you the accounting. 2 problems I had taken and shown you the end-to-end accounting. But maybe from the examination relevant, it may not have much relevance. So I'll not dive into the problems now, but I'll just explain it in theory or in words what it is. So lessor accounting is same as your accounting standard 19 ka accounting. Meaning in AS 19, you remember lease. Whenever there is a lease, we used to check whether the lease was operating lease or finance lease. Lessor accounting is same. First, lessor will check whether it is a finance lease or an operating lease. So how to check? For finance lease, they've given some indicators. What are those indicators? Present value of minimum lease payment approximates fair value of the asset. Okay. Lease term approximates useful life of the asset. Asset is transferred to the lessee at the end of the lease term, or lessee has an option to purchase the asset at the end of the lease term, and lessee is reasonably certain that he will go for this purchase option. Or fifth one. Excuse me, or asset is of specialized nature only where only lessee can use it without making major modification. So these are some parameters. Okay, even if one of them are satisfied, it's a finance lease. Even if all these indicators fails, then it becomes operating lease. That's how you need to test. Okay, so minimum lease payment here means who's making the payment here, lessor or lessee? Lessee is making what and all payments. One is paying lease rental every year, and he's also paying GRV, guaranteed residual value. So minimum lease payment means LP plus lease payment plus GRV. Anyway, we know that we have calculated LP. In lease payment calculation only, GRV will be automatically included. So you don't have to call it out separately, but just for your reference, I'm saying it. Okay. All right. This is one. Then maybe 2 minutes we'll spend on this. So you need to calculate the present value of lease payment. Basically, lease payment any which way will include GRV. Let's say present value of lease payment is 1 lakh. Okay. Present value of the lease payment, I'll call it. Though the standard uses the word MLP, because any which way we know that lease payment includes GRV, I'll keep this. So find out the present value of lease payment including GRV. That comes to, let's assume 1 lakh. Compare it with fair value of the asset. Let's say fair value of the asset is 1,10,000. Find out the percentage. Out of 1,10,000, 1 lakh you already recovered. So it means what is the percentage? 1 lakh divided by 1,10,000 into 100. So 1 divided by 1.1 into 100, if you do, that's about 91% roughly. Yes, no. Sir, if this percentage, standard AS does not say any percentage. For our simplicity, take if this percentage is greater than 60%, 60% or more, take it as finance lease. Nowhere, as far as my memory goes, percentage is not called out. Okay. So calculate this. If this percentage comes to 60% or more, you take it as finance lease. That's one. Same thing goes for lease term. Check if the lease term, if it is more or less equal to useful life of the asset. More or less means more than 60%, you take it. Okay. Compare lease term with the total life of the asset. If the lease term approximates, if it is 60% or more of the useful life of the asset, take it. That's one of the indicator of finance lease. Or if asset is automatically transferred to the lessee at the end of the lease term. Lessor gives off the asset to the lessee at the end of the lease term. If such a option is there, means that is also an indicator of finance lease. Or lessee has an option to purchase the asset at a price significantly lower than fair value. Lessee has an option to purchase the asset, let's say at 1 lakh rupees, but the fair value of the asset is, let's say, 3 lakh rupees. The value of the asset on the date of purchase is 3 lakh, but he has an option to purchase it just for 1 lakh. I mean, at a significantly lower price, he has an option to purchase. Do you think lessee will let go of this offer? No, probably he'll purchase it. That is the reason. This is another indicator of finance lease. The last is asset is of a specialized nature that only lessee can use it. If it is a customized asset where only lessee can use it, then that is also one of the features of finance lease. Okay. So why do we need to know this? So if it is a finance lease, the first thing lessor does is, lessor is really not interested in the asset. He is interested in the lease rental. Because you think logically here, what are the parameters? Lease term is equal to life of the asset. If the life of the asset is, let's say, 10 years, almost for 10 years he has leased it out. Lessor has given away this asset for 10 years. Asset will last for 10 years, and almost for 10 years if he has leased, means is lessor really interested in the asset? No. I mean, you apply substance over legal form ka accounting over here. Lessor is a financer. He's not interested in the asset. He's interested in lease rentals. So hence what the standard says is, in case of finance lease, lessor has to de-recognize the asset because he's not really interested in the asset. Whatever is currently showing, de-recognize it. What he's really interested is in the lease receivable. So show lease receivable. Not only we calling it as NI. NI as a net investment. Okay. All right. Then there is something called gross investment and net investment. What is this gross investment? GI means gross investment. Gross investment means, think from lessor perspective. What and all he wants to recover as part of lease. One, he wants to recover lease rental every year, and GRV and UGRV. All the three he wants to recover. Yes, no. So these three put together becomes your GRV. But all this lessor will be able to recover now or over the lease term. He'll recover all this over a period of lease term. That means guaranteed or gross investment is on future value terms. All this recovery will happen in future. But lessee, you're doing the lease accounting now. You're doing all this accounting now. Hence, we need the present value. So find out the present value of gross investment. Find out the present, use a discount factor using your IRR basically. Use your discount factor and find out present value of gross investment. That only we call it as net investment. So you record lease receivable. One receivable you record to the extent of net investment. Because you're doing the accounting now, you have to record it at present value. Okay. So recognize net investment. Let's say net investment value is 100, but the carrying amount of the asset is 80. So you'll cancel the asset by crediting it. You have to record receivable by debiting it. You can either write net investment account debit or receivables account debit, whatever, to asset account. There is a difference here. The difference is 20. That gain or loss will be transferred on derecognition of asset, balancing figure to P&L account. So you may get some gain or you may get some loss. In my example, it's a case of gain. So you transfer it off to P&L. Okay. If there is any IDC we'll talk about it a little later. It's considered for net investment calculation. IDC is basically what, sir? If IDC is like a DAC. DAC should be added to the cost of the asset. Here, lessor is showing the asset or is cancelling the asset. He's not showing the asset, right? What is he showing? Lease receivable. So IDC should be considered for lease receivable calculation. Okay. All the lease payments are inflow to the lessor, but IDC is an outflow. So reduce it. From inflow, you reduce this IDC portion. Whenever you're doing net investment calculation, IDC should be reduced. That's all. Okay. This is about finance lease, where he has to cancel the asset and show it as receivables, and the difference he'll transfer it to P&L as a gain or loss. Okay. Then you check whether it is an operating lease. If all the indicators of finance lease, if it fails, means it automatically becomes operating lease. For operating lease, it's a simplistic treatment. What is that simplistic treatment? Your golden days accounting. 11th grade, 12th grade accounting. Lease rentals, lessor is receiving. No, you don't have to do all the sophisticated accounting. Lessor will still show the asset. He will not cancel the asset. If it is operating lease, lessor will still show the asset. Whatever lease rental he is receiving he'll show it as an income. He'll book it as an income, but this income has to be booked on a straight line basis or any other systematic basis. Practically for all our problems, you'll book it on SLM basis only. Meaning you'll book same income to P&L. Lease rental, if lease rental is let's say 3 years. For all the 3 years, whatever lease rental you're receiving, you'll book it as an income. If you have received more show it as income received in advance. If you have received less from lessee, show it as accrued income, like that. But the income you transfer to P&L has to be same every year. So all this sophisticated treatment not required for operating lease. So that's what. Basically, same thing we discussed for recognition exemption, right? Lessee, when he has recognition exemption, he'll do the same accounting. But lessee will book that as an expense. Lessor will book it as an income. Same thing. That's about operating lease. Okay. Land and building. So land and building are two separate components. Okay. So two separate lease components. You have to do separate accounting for them. Okay. Then we discussed, remember you discussed something called sublease. If you want to take low value assets exemption, sublease should not have been done. We studied. So what is a sublease? We'll understand this through this particular concept. Sublease means, so lessee has taken the asset on lease and again he has given the asset on lease. Further, he has done the leasing. Okay. Lessee takes the asset on lease and he further leases it out. So the chain continues. So here there will be three parties, lessor, lessee, and one more lessee, because lessee has subleased the asset. He has given it on one more time on lease. That's the reason three party will be there, lessor, lessee, and lessee. Okay, this first lease we call it as head lease, and this lessor we call it as original lessor. Original lessor. For original lessor, if there is sublease, he doesn't have to bother anything. He'll do his normal accounting. If it's finance lease, he'll do finance lease accounting. If it's operating lease, he'll do operating lease accounting. He'll not be bothered by sublease at all. Sublease is something which this guy has to be worried about. Now lessee. So first lessee took an asset on lease. That means he's the original lessee. This lessee, we use another term. He's also known as intermediate lessor or sublessor, because after taking the asset on lease, he further gave it on lease. So hence we say this particular lessee, we call it as intermediate lessor or sublessor. For him, the whole lot of accounting changes. So for sublessor, that is this guy, what you have to do? First, he has taken the asset on lease. So you have to record ROU and lease liability. That is one. Then he subleased it. When he subleases it, when he again gives us on lease, now he becomes lessor. And lessor accounting, the moment lease is there, lessor has to think whether it is a operating lease or a finance lease. So this sublease, this lessee or intermediate lessor has to check whether it is a finance lease or an operating lease. If it is a finance lease, what to do? You have to derecognize the asset. What asset is the sublessor showing? He's showing one asset called ROU. That means he will derecognize ROU, because finance lease says asset has to be cancelled, and lessee is showing ROU, or intermediate lessor or sublessor is showing ROU as an asset. So that asset will be cancelled. Instead of that, what he'll book? He'll book net investment. So there will be a difference. There could be a difference between these two. That difference will be transferred off to P&L account. Whether it's a gain or loss doesn't matter. That is one. Okay. So that means this is gone. This ROU is gone, means no depreciation will come. So he booked lease receivable. Correct? Lease receivable is basically a financial asset. That means on this lease receivable, you are recording it at present value, but you will recover future value. So the difference between present value and future value is nothing but on the finance asset, you will book finance charges or finance income. You will book interest income. So on this net investment, you will book finance income. But you anyway have lease liability also. On this lease liability, the sublessor or intermediate lessor will book finance charges. So both finance charges will be there, finance income will be there. That means two amortization table will be there. One amortization table for lease liability, another amortization table for net investment. Net investment is nothing but your lease receivable. That's your finance asset basically. Okay. Just that instead of lease liability here, just a fancy name is given. That is nothing but your financial asset only. Okay. So that is a treatment for finance lease. Suppose this sublease was an operating lease. If it's operating lease means should we have to cancel the asset? No. That means ROU will continue. Lease liability will continue. If ROU is continuing means depreciation on ROU also will continue. If lease liability is continuing means the finance charges on lease liability also will continue. If it is operating lease means what will the lessor do? Okay? Whatever income he is receiving, he'll transfer it to P&L on a straight line basis. That one. Okay. Fair enough. This is the thing. What about this guy? Final lessee. This guy we call it a sub lessee. Okay. He's also a lessee. And Ind AS 116 is pretty clear. Whenever there is a lessee has to recognize two things, ROU and lease liability. So again, he will record ROU and lease liability because he can control the asset for few years. That's it. Okay. If it is a short-term lease or a low-value asset, then this lessee can take a recognition exemption. Otherwise, ROU and lease liability accounting becomes a must. Okay. Yeah. Next. Interesting, no? Yeah. All right. Next concept is sale and leaseback. Sale and leaseback. So name itself is saying first you sell and then you take the same asset back on lease. So like here, let's say A Limited, B Limited. A Limited will sell this asset. Let's say he sold one plant and machinery. Okay. For 10 lakh rupees. After that, he will take the same asset back on lease. Same asset, he lease it back. That means this guy, If not, maybe we'll just call out the names. This guy is a seller. This guy is the buyer. Correct? What will happen after sale? What will happen? The asset will come back to A Limited. That means lessee, he becomes the lessee and he becomes the lessor. Okay. This is the arrangement. This is your sale and lease back arrangement. First you sell, then you take the same asset back on lease. That means the seller will become lessee, buyer will become the lessor. Why did they do this? The reason is the sale and lease back is like a way to raise finance. Because when A Limited sells this machinery, he'll immediately collect 10 lakh rupees from B Limited. When he takes the asset back on lease, A Limited has to pay money to B Limited as lease payment. Let's say lease payment is 3 lakh rupees and the lease term is 4 years. Lease payment is 3 lakh rupees and the lease term is 4 years. That means totally how much is the lease payment? 12 lakh rupees. Check what has happened here. A Limited sold the asset. That means A Limited received immediately how much? 10 lakh. Okay. Later on, what is happening? He took the same asset back on lease. And how much he is paying totally as lease payment? He's paying 12 lakh. But the 12 lakh is not paying immediately. He's paying over 4 years. That means basically A Limited is used asset as a base to raise finance. Okay. So to raise finance, people do like sale and lease back or a transaction if at all they want to. Okay. Now we are talking about the accounting perspective. If at all there is sale and lease back, what to do? So first you need to check whether it is really a sale. Whether it is really a sale or not, you need to check Ind AS 115. Ind AS 115, it talks about revenue recognition. They give some criteria. They say you can treat it as sale when the control has been transferred. For control, there are certain criteria which we will study after this topic. We'll take that only. Okay. Or maybe if time permits, if shortage of time, we'll take a shorter topic and come back to the other one. We'll see. So first you need to check whether it is a sale, meaning sale criteria. Can you book it as a sale by satisfying Ind AS 115 criteria? If you say yes, as per Ind AS 115, it is a sale. Then for lessee, what to do? For lessor, what to do? We have to see. However, if it is not a sale, if you cannot book it as sale, as per Ind AS 115, if it is not a sale, then whatever money this A Limited has received, sir, it is treated as a finance arrangement. Okay, you will not do any accounting. How much money here A received? He received 10 lakh rupees. He will treat this 10 lakh as a finance receipt. Okay, he'll treat this 10 lakh rupees as a finance receipt. And finance receipt, you book it as financial liability. On financial liability, do your normal ACM accounting. Okay, don't have to worry about any of the leasing arrangement. This is really not a sale. This is purely a finance arrangement. So you book it as per Ind AS 109. So treat it as financial liability and do ACM accounting. If it is not a sale. However, if it is a sale, then there are certain steps you need to follow. Okay, certain steps we need to follow. So let's do a thing. I've called out all of this. Okay, but let's do one thing. Let's apply this with the help of one question only. Maybe a little better that way. Okay, this is your sale and lease back question. So let's run through this question. An entity, the seller lessee, sells the building to another entity, buyer lessor, for cash of 30 lakh rupees. So this is your sale value. Okay. Immediately before the transaction, the building was carried at a cost of 15 lakh rupees. So the carrying amount of building is 15 lakh. You have sold it for 30 lakh. Great. At the time of sale, seller lessee enters into a contract with buyer lessor for a right to use the building for 20 years. So after selling, he has taken the asset back on lease. So it's a sale and lease back. He has taken it for 20 years with an annual payment of 2 lakh payable at the end of each year. So 2 lakh he'll pay for over a period of 20 years. Great. The terms and conditions of the transaction are such that the transfer of building by seller lessee satisfies the requirements of determining performance obligation is satisfied as per Ind AS 115. So if performance obligation is satisfied, we know Ind AS 115 says if performance obligation is satisfied means you can book a sale. That means indirectly they're saying this is a sale. So it is a sale as per Ind AS 115. In this criteria only they'll ask, because if it is not a sale, the treatment becomes very, very straightforward, which they will not ask. They'll always, probably in exam, they'll always give it is a sale, meaning Ind AS 115 ka recognition criteria will be met. So here it is met also. The fair value of the building is 27 lakh. Okay, IDC they're saying ignore. IRR is a 12%, that is your discount factor, which is readily determinable. They're saying buyer lessor classifies this building as an operating lease. So if it is sale and lease back and operating lease, what to do, we'll see. How should the said transaction be accounted by seller lessor and buyer lessor? Both of them, how should they account is what they're saying. So here there are certain conditions. Now, one of the key factors you need to check is first the fair value. What is the fair value of the asset, sir? 27 lakh. The value of the asset is 27 lakh, but you sold it for 30 lakh. Correct? So that means you have sold over and above the fair value. That we call it as additional finance. The first step in this problem is to find out additional finance. Normally, sale should be made at fair value because value is that much only. Since you sold over and above the fair value, you will treat the excess amount received. Fair value is only 27 lakh. You sold it for 30 lakh. So the 3 lakh extra you received, no, we'll treat it as a finance, separate finance arrangement. So this is not part of your lease accounting. This is entirely different. You'll treat this as a finance arrangement. That we call it as additional finance. That's the first step. Okay. You need to follow this. You need to check in every problem whether this is there. Additional finance is there. Some problems may be there. Some may not be there. Check. That is one. Second thing is you're making payments. No, you're making 2 lakh every year payment over a period of 20 years. So that means it's a future payment. First, find out the present value of payment. Okay, how? 2 lakh you're paying every year for 20 years. Here. Since the payment is same every year, we'll use PVAF. So lease payment, or I'll say payment. I'll not call it as lease payment because it is not. I'll just say it as payment. Okay, it's not really lease payment. So just we'll call it as payment. So the payment multiplied by present value annuity factor at 12% given for year 1 to 20. So at 12%, if you find out PVAF for 20 years, it is 7.4694. So 2 lakh is the payment. Multiply this, you're going to get 14,94,000. That's the present value of total payment you have made. Okay, total payment is 2 lakh and you paid it over 20 years. So the total payment you are making is 40 lakh. In that 40 lakh is the future value. Present value of that is 14,94,000. Okay, sir. Now the funda is this after selling you have taken it on lease. No? You have taken an asset back on lease, right? Can you consider this entire 14 lakh as a lease? No. Why? Sir, if it was a lease arrangement, you should have sold the asset at fair value. Did you sell the asset at fair value or over and above? You sold it over and above. That means part of this payment is towards lease, part of this payment is towards additional finance. So you need to split. Okay, so total payment, because you did not sell it at fair value, you sold it at higher than fair value. Okay, so whatever payment you are making, no, some part of the payment will be towards lease. This is considered as a separate loan taken. Okay, to tell in layman language, there's an extra loan you have taken. So out of payment that you are making, some portion will be a lease payment, some portion will be loan payment. Okay, so present value of total payment is 14,94,000. How much loan did you receive? 3 lakh. The 3 lakh is already there on present value. That means what? Out of 14,94,000, 3 lakh is a payment made towards loan. That means what is the present value made towards the lease payment? Present value of lease payment is nothing but present value of payments minus additional finance. Present value of total payments minus additional finance. From 14,94,000, if you deduct additional finance, you're going to get 11,94,000. So 11,94,000 is the total payment that you made towards lease. Not the total payment, it's a present value of the total payment you made towards the lease. Okay, this is one we need. We need this. That's the reason we just say. So far I'll just go one step back again here. Okay, I don't have the time to explain the whole logic, so I'll just run through the working ones so that you remember. Easy only, just a few steps you need to keep in mind. First, check whether the sale has been made at fair value. If you have sold it over and above the fair value, you treat it as a loan. That we're calling it as additional finance. So additional finance is basically fair value minus sale value. That's one. Second, find out the present value of the payment. You're making payment, no? Find out the present value of total payment. Okay. Here the total payment, no, out of the total payment, some portion will be towards additional finance, loan, some portion will be towards lease payment. So total present value of payment was 1494. Since additional payment you already received now, the 3 lakh is already on present value terms. So reduce that. So 11,94,000 is the present value of lease payment that you're totally making. That is one. Okay. Then you're making every year 2 lakh payment. Every year you're paying 2 lakh rupees. Entire 2 lakh you cannot treat it as lease payment. Entire 2 lakh that you're paying, you cannot treat it as lease payment. Why? Because here there is only lease or there is loan also. Here there is lease also, there is loan also. So entire 2 lakh you cannot treat it as lease. So out of 2 lakh, some portion is a payment for loan, some portion is a payment for lease. Again, you need to find out. So out of this 2 lakh, how much portion is towards loan, how much portion is towards lease. So the payment portion towards loan is given by the formula AAP. You can remember like this, ArP&x Party, AAP. Okay, A for annual payment, another A for additional finance, P for present value of payment, like that. Okay, I'll not go into too much logics now. I'll just remember like this, ArP&x Party, remember like that. Okay, A for annual payment, another A for additional finance divided by P for present value of payment. So do that, you're going to get 4160. And every year, how much are you paying? 2 lakh. So in 2 lakh, 40,160 is towards loan, is towards additional finance. That means the remaining will be towards the lease payment. So what will be the present annual lease payments? Every year lease payment will be 2 lakh minus 4160, which will be 1,59,850. So this is the lease payment you're making every year. Obviously, you need that, no? That's the reason this one. Okay. Then, sir, you have taken an asset on lease means you need to recognize ROU. So ROU is given with the formula LCF. L for present value of lease payment, C for carrying amount divided by fair value. You can remember this as LCF. L for present value of lease payment into carrying amount divided by fair value. Why this is? So this is like a prorated accounting it is, right? So the fair value of the asset was 27 lakhs. But currently you are showing in your books, before selling, you are showing this asset in your books at 15 lakh. So carrying amount before sale was 15 lakh, but fair value was 27 lakh. Now you sold the asset, but same asset you have taken back on lease, no? That means, can I show the ROU also at same value? No, you can't show ROU also at same value. Why, sir? Sir, fair value, if you want to show currently you're showing the asset in your books at what value? 15 lakh. Okay. Now, after lease also, you can't show ROU at 15 lakh. Why? Sir, you can show the asset at 15 lakh provided you made a payment of 27 lakh because the fair value of the asset was 27 lakh. Did you make fair value is today, no? So we need not future value but present value. Did you make present value of lease payment of 27 lakh? No, your present value of lease payment we already found out. Present value of lease payment you made is only 11 lakh 94. If you had paid a 27 lakh, if present value of lease payment was 27 lakh, then you could have showed a carried amount of 15 lakh. But you paid only 11 lakh 94,000. We already calculated 11 lakh 94,000 is nothing but present value of lease payment. If you paid only this much means how much would be the carrying amount. So that's a pro ratio. If you don't want so much of logic, simply remember it as LCF. L for present value of lease payment. Okay, C for carrying amount divided by fair value. So do that, you're going to get 6 lakh 63,333. This is a prorated. So you will show ROU at this particular value. Okay, that's one. All right, next is, sir, you have sold off the asset. No, correct? You have sold off the asset. That means there'll be some gain or loss. So next is your gain loss wala accounting. First, find out the total gain. Sir, 3 lakh we are treating it as additional finance. Okay, 3 lakh we are treating as additional finance. Okay, so that is a loan. So leave that account, leave that 3 lakh aside. That means ideally you should have sold the asset for what value? 27 lakh. Don't take 30 lakh here. Okay, you have sold it for 30 lakh. Fair value of the asset is 27 lakh. So 3 lakh you're treating it as a loan altogether. So don't bring that extra 3 lakh into your lease accounting at all here. Okay, so 27 lakh is the value of the asset at which you should have sold, and carrying amount was 15 lakh. 15 lakh worth of asset, if you sell it for 27 lakh, you should have made a gain of 12 lakh rupees. That's your total gain. So entire total 12 lakh gain can be booked. No, you can't book. Why? Because have you sold the asset entirely or you took the asset back on lease? First you sold. After that you took the same asset back on lease. That means what, sir? Some part of the gain you have retained, right? So because entire gain you cannot account it because you have not sold the entire asset. Some portion of the asset still you have retained. So out of this 12 lakh gain, some portion of the gain you have still retained. That's what we call it as gain retained. That's given by the formula LGF. There it was LCF, no? Here it is LGF. Same component. L for present value of lease payment, G for total gain divided by fair value of the asset. L for present value of lease payment into total gain divided by fair value of the asset. Do this, you're going to get 536.67. This is what? Gains retained because you're making the payment. You're making lease payment. Why? To get control over the asset. If you have the asset with you means, have you lost the control? You still have control. So you have retained the control. So this is nothing but your gain retained. Out of the total gain of 12 lakh, 5,30,000 of gain you have retained. That means how much how much is the gain towards the rights of transfer? Because the entire asset you are not showing as ROU. Only some portion you are showing as ROU. That means some control you have lost. Some control you have lost means some gain or loss you need to account. Okay. So the total gain was 12 lakh. The gain retained was 530. That means what is the gain transferred? So 12 lakh minus 530 will give you 6 lakh 69,333. This much is the gain on the rights transferred. This much, in fact, you have also, this much you have sold. So this much gain only you can book it in your P&L. That's your thing. Okay. So the journal entry is quite simple. You have sold the asset, so bank account will be debited. Asset will be credited. You have taken it asset on lease, so ROU will be debited. Lease liability will be debited. There is some additional loan also, so additional finance will be credited. And there is a gain, and gain will be credited. That's all is your entry. Plug in the respective amounts. You sold the asset for 30 lakh, recognize it. ROU already know. ROU should be recognized at 663,333. Okay. Then to PP you sold. So that means what? You have to de-recognize the carrying amount. Carrying amount was 15 lakh. You credited. Lease liability initially you measure it at fair value of, or rather present value of lease payment. You already got present value of lease payment somewhere here only, which is 11 lakh 94,000. So record this at 11 lakh 94,000. Additional finance was 3 lakh recorded. Then gain is 669,333. You can write this gain as a separate calculation or get it as balancing figure also in case you don't have time. So the last 3 working, if you don't have time, you can get that as a balancing figure. Okay. Journal entry you can put up and you can get that as a balancing figure. You may lose 1 or 2 marks, but it may be worth it in terms of time. Okay, sir. That is fun. This is the journal entry. Lessee will book for the sale and lease back. Okay. Just one quick step. We will revise again. What is it again? First you sell and then you take the asset back on lease. So first check, have you sold over and above the fair value? If it is the case, it's a case of additional finance. Additional finance is basically sale value minus fair value, which in this case was 3 lakh. Okay, that's one. Then find out the present value of the payment that you have made. Present value of total payment that you have made. Okay. In that reduce additional finance, you will get the present value of lease payment. From the present value of payment, if you reduce additional finance, you're going to get the present value of lease payment. That's one. Okay, next you need to find out is, you're making every year some payment of 2 lakh you're making. But that out of that 2 lakh, some portion is towards lease, some portion is towards loan. So you need to know how much is towards the loan. That is given with the formula ArP party, AAP. A for annual payment into additional finance divided by present value of payment. So do that. You got 4160. So out of 2 lakh, 4160 is towards loan. So the balance will be towards the lease payment. That's one. Okay, then ROU. ROU is, you have to do it on a prorated basis over here because entire asset you can't record it. Some portion of rights you have transferred. That's the reason it's a proportionate amount given in the formula LCF. L for present value of lease payment, C for carrying amount divided by the fair value. Do that, you'll get the ROU ka balance. Okay. Then find out the total gain. How do you get the total gain? Total gain is nothing but your fair value minus the carrying amount. Don't take over and above the fair value, because over and above the fair value is your additional finance, which we have already separately recognized as loan. So here fair value minus carrying amount you take, that is the total gain. Total gain you cannot record it because you took the same asset back on lease. Only some portion of the control you have lost. Some portion of the control you still have retained. So how much is the gain towards the control retained? That's given with the formula LGF. Present value of lease payment into total gain divided by fair value of the asset. So out of 12 lakh, this is a gain retained, means the balance will be rights transferred. The journal entry is simple. Bank account you debit, asset account you credit. Then ROU debit, lease liability credit. Additional finance credit, balancing figure is a gain or loss, which is this. Okay. This is a journal entry for lessee. For lessor, what will be the entry? Lessor is simple. He purchased the asset. No, that means he has to record the asset. Okay. He'll record the asset at fair value. What is the fair value of the asset? 27 lakh. But how much payment he made? 30 lakh. So he'll credit bank for 30 lakh. Balance 3 lakh. For lessee, that 3 lakh was additional loan taken. For lessee, it was loan taken. For lessor, it will be loan given. Lessee, it's a loan given, which is nothing but your financial asset. Okay. So you'll book that 3 lakh as a financial asset. Okay. That means what? Lessor is receiving 2 lakh every year. Out of 2 lakh received, some portion is towards lease, some portion is towards this loan given. What portion? That we have already found out. 40 something we found out here. No? 40, 160 is towards loan and 159, 840 is towards lease. The same thing he will also account. Okay. 159, he'll treat it as lease payment. If it's a finance lease, he'll do finance lease ka accounting. If it's operating lease, he'll do operating lease ka accounting. Okay. This is your normal additional finances. This is a recovery which will help you to prepare your ACM table for financial asset. That is your sale and leaseback. Okay. Yes. Next, all that only same thing I've written in the steps over here, whatever we studied. Okay. This also we covered. Next, what is next? Oh, okay. IDC. IDC we already said. Sometimes what happens, you may have to incur some cost to enter into a lease arrangement. Like a broker may help lessor and lessor to get into the lease arrangement, lessor and lessee to get into the lease arrangement. That brokerage we call it as initial direct cost. First, you need to check who has incurred that IDC. If lessee has incurred, means IDC is like a directly attributable cost. So it has to be added to the cost of asset. Is lessee showing any asset? Yeah, he's showing ROU. So add it to the cost of ROU. Okay. Suppose if it is paid by lessor. Lessor does the accounting based on finance lease or operating lease. If it is finance lease, means what is lessor doing? He's showing the asset? No, he's de-recognizing the asset. But he's showing what? Receivable. So consider this IDC for your receivable wala or net investment wala calculation. Okay, that one. However, if it's operating lease, means will lessor cancel the asset? No, he will show the asset. So in that case, IDC will be added to the cost of the asset. That way. Okay. All right. Another one is if it's a manufacturer or dealer lessor, what to do? So normally lessor, what he will do? If it's a finance lease. If it's a finance lease, he will cancel the asset. So asset account, he will credit. Let's say asset ka carrying amount is 100 rupees. He will credit asset the carrying amount value. And he will record net investment at present value. He'll find out the present value of gross investment. That is nothing but present value of lease payment plus present value of GRV plus present value of UGRV. He'll find out. That only be calling it as present value of gross investment or net investment. Let's say that comes to 120 assumption. Then whatever is a balancing figure, it's a gain, you will transfer it off to SPA. This is a normal accounting we do. This is booked as an other income. Lessor will book this 20 as an other income. Okay. But in case of manufacturer or dealer lessor, no, same accounting is there. If he gives manufacturer or dealer lessor, other than selling the product, if he also gives some product on lease, okay, he also has to do the same accounting. But booking it as other income is not appropriate. This 20, no, showing it as other income is not appropriate because the main business of this manufacturer dealer is this only, no, correct? He's selling this product in the ordinary course of business. So you cannot pass this entry. Okay. He has to book it as sales. Okay. That means what will manufacturer lessor do is he will book net investment. Okay. He will credit the asset also, or he'll de-recognize the asset also, but he has to recognize revenue. He has to recognize revenue and he's showing this goods as an inventory. He has to de-recognize inventory and inventory will be shown as cost of sales. So he will write cost of sale account debit. This is the entry he will pass. If you do the comparison between this entry and this entry, amount will be same. The final effect will be same. Here, how much did you get as gain here? 20. Here also, if you just compare cost of sale with sale amount, no, the difference will be 20 only. Okay, but you cannot book it as another income, but rather you have to book it as a revenue and cost of sale. That is a drama with respect to manufacturer and dealer lessor. So now net investment at what yearly you book, you know. Asset has to be de-recognized at carrying amount, that also you know. So the only question now is at how much value we need to recognize cost of sale and how much value we need to recognize at sale value. That's the only drama. If you get this over question, that's all. Sir, normally you sell the product at what value? Fair value. Okay, but have you sold the product here or have you given it on lease? Have given it on lease. That means what will you recover? Lease payment. Lease payment you will recover it in future, but sales you're booking now. So hence sale should be recorded at lower of two things. One is the fair value of the asset or present value of lease payment, whichever is lower. Present value of lease payment or fair value, whichever is low. Generally you sell it at fair value, but sometimes you may sell it below fair value also. Here, that's the reason. So you'll book the sale value either at present value of fair value or present value of lease payment, whichever is lower. But if you check lease payment, no sir, lease payment will only include GRV and lease rental. But I already told you that whenever you're doing calculation from lessor perspective, even UGRV has to be considered. But you cannot add UGRV to this component because lessee is not paying that, right? That's the reason instead of adding UGRV to sales, you reduce it from cost. Instead of treating it as an income, treat it as a reduction of cost here. So you can't add UGRV here because lessor is not recovering this from lessee. He'll recover it, just not from the lessee. That's the reason instead of adding UGRV to income, you will reduce it from cost. So cost of sale will be recorded at cost of the asset because inventory will show at cost. No? So cost minus present value of UGRV. You can't take UGRV because recovery of UGRV will be in future. Hence, we always take present value of UGRV. That's all is the whole funda about this. Rest everything you know, only these two components. Sale will be recorded at fair value or present value of lease payment, whichever is lower. And cost of sale will be recorded at cost of the asset less present value of UGRV. That if you do, rest every step is ditto. Okay, maybe let's do a thing. Let's quickly apply it in one other question just to understand this a little better. This also could be a popular question in examination. A lessor enters into a 10-year lease and with an equipment of lease. Equipment is not specialized nature and is not expected to have alternate use, blah, blah, blah. Under the lease, they've said, lessor receive annual lease payment of 50,000 every year. At the end of each year, they said, okay. Lessor expects a residual value of 50,000 at the end of lease term. Lessee provides a residual value guarantee that protects lessor for first 30,000. Okay. So total residual value is 50,000. Is entire 50,000 given as guarantee? No, lessee has given guarantee only to the extent of 30,000. That means the UGRV indirectly they're saying is 50,000 because these two put together will become residual value. No? So 20,000 is UGRV indirectly they're saying. Okay. All right. The equipment has an estimated economic life of 15 years. Carrying amount of the asset is 1 lakh. Fair value of the asset is 1,11,000. Lease does not transfer the ownership. Okay. Interest rate IRR is given to be 10.05%. You need present value calculation. For that we need to use this. So how do we need to do this? Okay. They'll generally mention in the problem over here. Okay, whether it's a manufacturer, dealer, or lessor, there they'll give it to you. Okay, here is the concept, and below that concept, this question is given. So it's implied that this is a manufacturer or dealer, lessor. In the examination, it will be clearly called. So what do you need to do simply? Entry is very simple. The final entry you already know, which is what? Net investment has to be recorded. Asset needs to be derecognized. Other than that, you can't book other income here. You have to recognize cost of sales and revenue. So first, let's find out net investment. How do you get net investment? Present value of lease payment. Lease payment includes your GRV and present value of UGRV. Let's find out the things separately first. First, let's find out only present value of lease payment. Why? In a bit, I'll tell you. Don't include UGRV. Only find out present value of lease payment. Lease payment means it will only include lease rental and GRV. How much is lease rental every year? Lease rental every year is 15,000. Every year you will receive for how many years was this? How many years? For 10 years. So it's 10 years at 10.707% if you consider PVAF. I've got it as 6.1240. So 15,000 multiplied by this you do. Plus GRV, guaranteed residual value is 30,000. This you will get it at the end of 10th year. So you have to consider PVIF over here because you will only get this once. Okay. So that means present value of lease payment will be 103,350. This does not include UGRV. Okay. Then let's calculate net investment. Net investment means what, sir? Present value of lease rental plus present value of GRV plus present value of UGRV. Present value of these two you already computed, which is 103,350. Only UGRV ka present value you need to compute. How much is UGRV? 20,000. UGRV also you will expect it at the end of the lease term. So the end of the lease term, PVIF is 0.383. So do that, you're going to get net investment of 111,010. That's one. Next is what, sir? You have to find out what kind of a lease is this. Okay. Whether it's because you'll do the derecognition accounting only in case of finance lease. You'll do all net investment and derecognition of account, all this accounting you'll only do if it's a finance lease. Don't forget that. Just because you see manufacturer and dealer lessor, don't straight away go ahead with that. You'll recognize lessor will recognize net investment and he'll derecognize the asset only if it's a finance lease. One of the parameters to check finance lease is what, sir? Present value of lease payment will approximate the useful life of the asset. That's the reason we calculated present value of lease payment separately. Okay. So hence UGRV we completed separately. So what is present value of lease payment? 103. It should approximate to the fair value of the asset. Do you know the fair value of the asset? Yes, it is 111. And if you calculate the percentage, it's coming to 93%. I told any percentage more than 60, you conclude that it is a finance lease. So it is more than 60. So therefore this is a finance lease. If it's finance lease, asset needs to be de-recognized, net investment should be recorded. Okay, that's one. Along with this, sales also has to be accounted. Sales will be booked by manufacturer, dealer, lessor at what value? At fair value or present value of lease payment, whichever is lower. Present value of lease payment is 103,350. Fair value is 1,10,000. So the lower of the two is 103. So you will book the sales at this value. That's all? No, even cost of the sale has to be accounted. Cost of the sale will be booked at the cost of the asset, which is nothing but carrying amount here, which is 1 lakh, minus present value of UGRV. You already calculated present value of UGRV, which is this, which is what, sir? Amount if you calculate, it will be 7660. So cost of the sale will become 92,340. Okay. So the final entry will be net investment account debit. Net investment ka value is 111,010. Okay. 2, you'll de-recognize the asset and its carrying amount. Carrying amount is 1 lakh. Sales, you'll recognize it at this amount as per working note. Cost of sale, you'll recognize it that amount. Okay. This is for manufacturer, dealer, lessor. If it was a normal lessor, what would have been the entry? You'll write net investment account debit this to asset account 1 lakh. You would have booked the gain in SPL to the extent of 11,010. Check if you want. Here, the only extra fitting is this and this. So compare this. 103,350 minus 92,340 you do. 103,350 minus 92,340 if you do, you are getting 11,010. Same 11,010 you will get in a normal problem also. In normal problem, for normal lessor, you book it as other income. Here you can't book it as another income. You have to route it as sales and cost of sale. That's the only distinction factor. Rest everything is ditto. Okay, so this is done. Next is some transition option. Okay, 1 minute. Transition option. Ind AS 116 transition wala option. So earlier used to follow AS 19, and before that, before Ind AS 116, no, I think Ind AS 116 came into picture only on 1st April 2019 onwards. Ind AS 116 is applicable only from 1st April 2019 onwards. So it's relatively a new standard. Before that, we had Ind AS 17. We had Ind AS 17, which talks about lease. So Ind AS 17 and 18 AS 19 was same. Ind AS 17 and AS 19 was same. That means if you had learned AS 19 properly, and if Ind AS 17 was applicable, no, more or less the standard was over. Okay, because even Ind AS 17 said accounting has to be done both. Okay, whenever there is a lease, first check whether it is an operating lease or finance lease, and accordingly do the treatment. That's what Ind AS, like AS 19, Ind AS 17 also said the same thing. But Ind AS 116 takes a whole new approach. It says if there is a lease, lessee has to record ROU and lease liability. It doesn't matter what kind of a lease is it. It could be whatever lease. Lessee will not even bother about the lease. It could be finance lease or operating lease. Lessee will always book ROU and lease liability. Okay. So if you are moving from AS 19 to Ind AS, because once Ind AS is applicable, you have to move over to Ind AS. So there are some transition provisions. Because the accounting treatment of AS 19 and accounting treatment of Ind AS 116 is entirely different. Right? So how should we transition from here? How should we go there? So that we needed some guidance on this. So this is your transition provision. Okay. Practically now, okay, we'll not go in there. It's fine. Okay, so there are 3 alternatives available, sir. One is full retrospective approach, then modified retrospective approach, alternate number 1, modified retrospective approach, alternate number 2. 3 alternatives. You can go for whatever you want. Okay, the easiest one is this. Practically everybody will go for this only, but we have to know all because we are students and anything could be asked for us. Okay, so full retrospective approach. Sir, name itself is saying full retrospective approach. Simple. Sir, Ind AS 116 is applicable from which date? 1st April 2019. That means the year will be 1st April 2019 to 31st March 2020. Whenever you prepare financial statement for current year, you not only give current year ka data, you also give previous year ka comparative data. So previous year comparative data will be 1st April 2018 to 31st March 2019. Okay. So if any adjustment, if you have to do before 1st April 2018, no, so you have to do something called, you have to prepare something called opening balance sheet. You know this. So in this case, we have to prepare something called opening balance sheet. If any adjustment relates to a data before 1st April 2018, we'll give that effect in opening balance sheet. Okay, so we have to also prepare something opening balance sheet on 1st April 2018. So what does this first approach says? Name itself is saying full retrospective. What full retrospective approach says is Ind AS may be applicable now, but lease you must have taken maybe 5 years ago, 4 years ago, whenever, we don't know. So from the beginning, if Ind AS 116 was applicable, means what would be the lease liability ka balance, what would be the ROU ka balance, do it and account it like that on 1st April 2018. So from the beginning you work. Right now you are doing the working as per AS 19, right? Correct. So in first full retrospective approach, what you have to do is from the beginning, let's say you have taken the lease 5 years before. So 5 years before only if Ind AS was applicable to you, means what you would have done. right? You would have found out lease liability and ROU. ROU would have depreciated. Lease liability you would have put up ACM table. So do that, okay? And find out what is the lease liability balance and ROU ka balance on the opening balance sheet date, which is 1st April 2018, and record it at that, okay? And do you think ROU and lease liability balance on 1st April 2018 will be same? Initially, it will be same. After that, ROU will get depreciated. For lease liability, you do ACM accounting. So balance will change. So there will be a difference. The difference you transfer it off to retained earnings. Okay, that's the fund. So you go back from the beginning and do your calculation and recognize ROU and lease liability on the opening balance sheet date. Difference you transfer it off to retained earnings. That is one approach. Okay. All right. Second approach is modified retrospective approach, meaning some cushion or extra relief is given. So what they are saying is lease liability, no, you don't have to do it from the beginning. Do it prospectively, meaning after Ind AS is applicable, calculate lease liability. You don't have to do it from the beginning. Do it prospectively, meaning now Ind AS is applicable for you. When is Ind AS applicable? 1st April 2019. On 1st April 2019, find out lease liability. How do you normally find lease liability? Present value of future lease payment, future cash flows remaining. So find out how much is the future lease payment remaining. Record lease liability. For this, you need discount factor. Which discount factor to use? Whatever is the discount factor applicable, on the day Ind AS is applicable. On Ind AS applicability date, which is 1st April 2019, check. If you know IRR, take IRR. If you don't know, take incremental borrowing rate. On Ind AS applicability wala date, and find out lease liability value. That is the practical relief given. But for ROU, however, you have to do it from the beginning. That's the reason modified retrospective approach. For lease liability, prospectively. For ROU, retrospectively. That means you have to do it from the beginning. That means old rate, sir. No. You have to find out ROU from the beginning using rate. Obviously, if you're finding ROU means, how do you find out ROU, sir? ROU is initially measured lease liability only, So you have to indirectly work out lease liability from the beginning. Okay, fine. That will give you initial value of ROU. Then you have to depreciate. But to find out initial value of lease liability, you need a discount factor. So what discount factor to use? The old date from the beginning. No. Ind AS says that you use incremental rate applicable on 1st April 2019. Whatever rate discount factor was there when the Ind AS became first applicable, which is 1st April 2019, use that to find out ROU. But ROU has to be worked out from the beginning. Okay. Lease liability prospectively, ROU retrospectively, like that. So obviously, and you will record ROU and lease liability only on 1st April 2019 onwards here. So you need ROU balance on 1st April 2019. Previously, you needed ROU and lease liability balance on 1st April 2018. Here you need it on 1st April 2019. So obviously there will be a difference. Difference will be going off to retained earnings. So that's your modified retrospective approach. To summarize, lease liability, you do it prospectively. ROU, you do it retrospectively. Retrospectively means from the beginning. But you use what rate? The rate you will use on the day Ind AS is applicable, not the old rate. From the beginning, rate you don't have to use. Whatever is the rate applicable when the first Ind AS became applicable, which is 1st April 2019, use that as a discount factor and find it out. Okay, like that. The last is modified retrospective approach, alternative number 2. Alternative number 2, what this says is lease liability same as the previous option. Previous option means the day Ind AS is applicable, find out lease liability freshly. Okay, how do you find out freshly? Present value of future lease payments remaining. Using what rate? The rate applicable on the day Ind AS got applicable. Same, whatever you did here on the previous approach, same approach you do it under alternative number 2 also. Okay, and if you get lease liability as 1 lakh, ROU also you make it as 1 lakh, don't bother. Okay, that's what that means. Both of them what? Prospectively. Okay, what do you think companies will follow? Obviously they will follow this because this is the easiest one. Correct or no? Okay, but we need to know everything because in question we don't know what they'll ask. They may ask alternative 1, alternative number 2, or full retrospective approach. We don't know, so that's the reason we need to know. Okay, so that means in this option you find out lease liability prospectively. Whatever is the value of lease liability you get, ROU value also you show it as same. Meaning think that you have taken the asset on lease now. This approach is like that. Think that you have taken the asset on lease now. If you take an asset on lease now, what do? Lease liability you recorded at present value of lease rentals remaining. ROU and lease liability you make it as same. And then for ROU you depreciate, lease liability you do ACM accounting. That is this approach. So this is total prospective approach basically. Okay. So obviously this is the easiest one. So companies will obviously go for that one. Okay. So that's about your transition wala approach. Okay. Yeah. Next, what is that? Here, I think we had one question. I put it on hold there. In fact, I'll just show you the concept and maybe if the lease was in foreign currency, question number 52. I told I'll do that later, right? So we'll run through those questions. I think that is the last one in this particular concept. Entity X is an Indian entity whose functional currency is Indian rupees. Okay, it has taken a plant on lease from entity Y for 5 years to be used in manufacturing. So lease term is 5 years, but they're paying annual lease rental in $10,000 US. So they're not paying the lease rental in rupees, they're paying it in dollars, foreign currency. On the commencement date, the exchange rate was $1 is equal to 68. This we call it as, if you remember our class, we used to call this as transaction date ka spot rate. On the day you enter into a transaction, the exchange rate we call it as TDSR, as in transaction date spot rate. Okay, then average rate was 69. We use average rate for income and expense wala conversion. Exchange rate at the end of the year, exchange rate was 70. That is now we call it as closing rate. Okay, incremental borrowing rate was 5%. This is your discount factor. Incremental borrowing rate of entity for US dollars. So since the lease payment is in dollars, you have to take discount factor related to dollars. Same like value in use. You're in impairment, we did value in use, remember? Take the cash flow in dollars, take the discount factor also related in dollars. So you will get value in use in dollars, then convert it in Indian rupees, more or less same approach over here. Okay. So you have to take dollar related incremental borrowing rate, which is given as 5%. So how will you do the accounting? That's all it is. There's a lease, no? So normal accounting. Initially, how do you find out? The lease liability. How do you get lease liability? Present value of future lease rental. Don't find out present value of lease rentals in rupees. You do it in dollars. So this is the dollar value. Yeah. Take the dollar ka discount factor itself. So you get the present value of lease payment. So this is what? This is in dollars. So first find it out in dollars. Okay. Correct. But can you account it in dollars? No. You have to do it in, initially you have to recognize ROU and lease liability. You have to recognize in rupees. So the first journal entry you will pass is ROU account debit to lease liability. What is the lease liability? 43,300. Initially ROU and the lease liability will be accounted at same value, but you can't account 43,300. This is the transaction. No? We have transactions happened now. We know this Ind AS 21 and AS 11 also, if you remember. Initially, whenever transaction happens, transaction has to be recorded transaction date ka spot rate. So when this particular transaction happened, what was transaction date ka spot rate? It was 68. So you will convert this at 68. Okay, so 43,300 into 68, you will call this as 29,44,400. Okay, this is the entry. 29,44,400 you will pass. Done. Okay. And then ROU. Sir, ROU is a non-monetary item. We'll study more about this in Ind AS 21. ROU is a non-monetary item. For non-monetary item, okay, if your non-monetary item, if you're once you have converted, no sir, further you don't have to remeasure. Okay, but once you have already converted into Indian rupees, no, then you don't have to worry about it at all. No exchange gain or loss will arise on account of non-monetary item. There is one more specific things there that I'll talk about it in Ind AS 21 when we get there. Okay. For now, you can think non-monetary item are not restated. Once you convert them into Indian rupees, that value state. Okay. Thereafter, this ROU go on depreciating. This is anyway in Indian rupees, so you'll get depreciation also in Indian rupees. So we don't have to worry about that. However, lease liability is a monetary item. Monetary item means value is fixed. So how is value fixed, sir? Value changes? No. So value fixed means the value could be fixed in any currency, not in Indian rupees. I know in Indian rupees the value is not fixed. Due to exchange rate, value will keep changing. When we say monetary item, no, when we say value is fixed, value could be fixed in any currency. Here, how much lease payment you have to make every year? $10,000. Is that changing? No, every year you have to pay $10,000. Correct? I mean the value is fixed. It's fixed. It may not be fixed in Indian rupees, but it's fixed in dollars. It could be fixed in any currency. If the value is fixed in any currency, we call that as a monetary item. So here, lease liability is a monetary item. So what Ind AS 21 says is all monetary items should be restated at year end using closing rate. So there will be things. So what you have to do is on lease liability, you have to put up ACM table. So let's put up ACM table. Don't put up ACM table in Indian rupees. Put it in dollars only. Because for different components, we have different rates. That's the reason. First take, this is your opening balance. What is ACM table? Only for 1 year you do because whole year accounting they have not asked. Only in first year accounting they've asked. That's the reason. First you take opening balance. Then finance charges. You don't interchange the columns. Okay, you call it out like that only. First you will put up, or maybe I'll just show it over here. So first is year, then you will take opening balance, and then you will take finance charges, then you will take payment, and then finally you will take closing balance. Okay, first year. What is the opening balance? Let's do it in dollars only. Initially balance is 43,300. So take it as 43,300. Finance charges, I think here you book it at what rate was that? 5%. So book it at 5%. So 43,300 into 5% will give you 2,165. Payment you are making 10,000. So this is your, just bring this down a little bit. Okay, this I'll call it as column number 1. This is column number 2. Column number 3 is equal to 5 multiplied, or column number 2 multiplied by 5%. This is your column number 3. And how do you get closing balance? 4 is equal to 2 plus 3 minus 4. So calculate that. 43,300 plus 2,165 minus 10,000. You're going to get 35,465. That's what they must also got it over here. Yes, sir. They've interchanged the table. You don't change it. Okay. All this is in dollars. Correct? Now this is in dollar data. Now we have to use the exchange rate and convert it into Indian rupees. Okay, so this is opening balance. That means it is initial transaction. Initially you recorded at 43,300. You know this. Initially when you enter into a transaction, all transaction, doesn't matter whether it is monetary or non-monetary, everything will be accounted using transaction date ka spot rate. Initially when you enter into a transaction, everything, monetary, non-monetary are recorded at transaction date ka spot rate. What was transaction date ka spot rate? We got it over here, 68. So this you will convert it using 68. Finance charges is an interest charges, sir. Interest is an expense. For all income and expenses, we use average rate. What is average rate? 69. So convert this using 69. Payment. Payment is a settlement. Sir, all settlement will be done at settlement date ka spot rate. Initially, transaction will be recorded at transaction date ka spot rate. Settlements will be recorded at settlement date ka spot rate. When are you paying this lease payment? End of the year. At the end of the year, what was the rate? 70. So you'll use settlement date ka spot rate, which is 70. Closing balance, sir. Since this is a lease liability, and lease liability is a monetary item at every reporting period. At every reporting period, monetary item should be shown in the balance sheet at closing rate. So closing rate is 70. So converted at 70. So multiply these two. So I've already shown it over here. If you multiply the respective rates over here in INR, this will become 29,44,400. This will become 7 lakh. This will be 149,385. Okay. So in fact, maybe I'll just copy this. 29,44,400. And this one is 149,385. And this is 7 lakh. And this, if you multiply, you're going to get 24,82,550. 24,82,550. Okay. Now, sir, what you do is simply add. How do you get this closing balance, sir? This plus this minus this, right? So do this. So if you do 29,44,400 plus 1,49,385 interest minus 7 lakh, if I do this calculation, I am getting 23,93,785. If I do this calculation, I'm getting 23,93,785. But lease liability ka closing balance should be 24,82,550. I want 24,82, but I'm getting only 23,93. So that means there is a difference. Currently, lease liability ka balance is 23. Required is 24,82. That means I have to increase. So 24,82,550 minus this. These two ka minus, if you do, how much it will be? 24,82,550 minus 23,93,785. If you do, my calculator is showing 88,765. There is a difference. So lease liability balance you need to increase. This difference is due to the exchange loss. Liability value is increasing. No, that means this is an exchange loss. So this particular thing you'll book it as an exchange loss. That is what I've called it over here. Okay, sir. You have to pass the entry. Entry, you know, no. For finance charges, what is the entry? Finance charges account debit to lease liability. For payment, what is the entry? Lease liability account debit to bank. Since there is an exchange loss will be debited. So SPL account debit to lease liability 88,765. Those are the entry. They have also given the entries over here for your reference. All right. So that's what they've called out. They've not told the exchange loss separate calculation. They've told it in words. But that's what it is all about. Okay. Yeah. I think 1 second. Let me just confirm. Mostly everything is covered. Yeah, better to just watch out once. Yes, people. So with this, Ind AS 116, one big ticket standards fully we have covered. Thank you.